I'm Shauna Smith alongside Brad Smith, and welcome to Yahoo Finance's flagship show, The Morning Brief. Let's get to the three things that you need to know today.
Good morning, everyone. First up, the latest read on the U.S. economy. September retail sales data coming in a little hotter than anticipated last month amid continued strength in the U.S. consumer, while weekly initial jobless claims came in lower than expected. Meanwhile, you've got a warning on the economy from Treasury Secretary Janet Yellen in remarks set to be delivered today. Yellen says former President Trump's tariff plans would reignite inflation.
Plus, U.S. stock futures getting a bid this morning amid today's economic data and after strong results from the world's largest chip manufacturer, TSMC. The company hiking its revenue outlook amid robust demand for artificial intelligence. And those results easing investor concerns amid a rotation in the stock market that saw small cap stocks outperform.
And earnings season continues, folks. Regional banks out with results this morning, showing some continued strength here. But all eyes turn to streaming giant Netflix. Are you still watching? They report results after the bell today. Can higher prices send the stock on another tear? We will see. Semiconductor heavyweight TSMC lifted its revenue outlook after a stronger than expected quarter. It's really helping some of these fears, though, of a slowdown in the AI hardware boom, or at least putting some of those fears off, I should say. The company's U.S. listed shares jumped in pre-market, lifting fellow chip makers Nvidia, ARM, and Broadcom here. Taking a look at some of the other results here that we've gotten, because of course we got the monthly results that kind of help us put together a picture of what TSMC would ultimately be able to communicate to investors here. But adding some additional color to this year-over-year third quarter revenue, increasing by about 39%. Net income, diluted EPS, both increased as well here by about 54%, 54.2%. And compared to the second quarter of 2024, third quarter results also quarter over quarter represented a 12.8% increase in revenue, 31.2% increase in net income as well here.
Yeah, and I think the big picture is that this is really putting to rest some of those concerns that we saw creep into the market and trigger a sell-off, a global sell-off that we saw in so many of these chip names earlier this week, and that was on the back of results from ASML. And I was parsing through some of the commentary that we're getting on the street here this morning, and really what we've gotten over the last couple of days. And there was a recent note out from UBS that caught my attention. They were basically talking about the fact that they don't necessarily see ASML, really the kickoff here to chip makers this earnings season, as being a reliable predictor here in terms of some of that growth that we are going to see. And I think the results that we got out this morning from TSMC very much prove just that. Once again, showing the fact that demand for artificial intelligence remains very strong, and as a result, we're seeing a tick higher, and you can see it across the board on your screen right now. You've got Nvidia up just about 3%. You have ARM even moving to the upside about 4%. So I think this earnings season is going to be key as we get a better idea of what that future growth looks like. And there has been also some talk just about a bit of a divide just in terms of consumer demand on the product side and consumer tech demand. Maybe that could be just a little bit mixed. But when it comes specifically to the AI demand and the global chip story and what we were seeing this morning, it looks like investors feel a little bit more confident maybe about the future.
We both grew up in Southeast PA, so we can all appreciate this King of Prussia Mall reference here. So ultimately, thinking about the broader chip landscape right now and trying to figure out exactly where we are from the hype phase all the way out into everybody being able to touch and feel the product and take it home and also experience the product, it's almost like you still need a "you are here" type of map within that mall. And you are still in so much of not just the hype phase, but the scaling phase. And that's why these chip companies are continuing to see and be able to tout some of this demand, because everyone is still trying to scale up until we can get to the point where we're finally at that model stage to figure out exactly where these things are going to play into our everyday lives, that are then the applications sitting on top of those models, sitting on top of the chips.
You know, I have to be honest, I did not know where you were going with the King of Prussia Mall reference at the
bring it
start of
full
that
circle.
point, but you brought it all the way back home, and it makes a lot of sense to me. If you're not familiar with it, It's a massive mall. And that's what you were trying to say,
Yes.
just in terms of you are still here and some of that growth then going forward. All right, the resilient consumer in focus this morning. Retail sales growing 0.4% in September from a month ago, slightly more than what analysts were expecting. And the jobs market not signaling a slowdown. Jobless claims coming in below the street's expectations. Of course, that is viewed as good news here for the health and stability of the labor market. Here to break it all down, we want to bring in Kathy Bostjancic, Nationwide Chief Economist and Senior Vice President. Kathy, it's great to have you here. So when you take a look, let's start with retail sales. It was broad gains. We saw this rebound in discretionary spending here this morning. Talk of this, there's some talk of this report now boosting the narrative that's been out there in the street over the last couple of weeks or so about boosting the idea of that no landing thesis. What do you think?
Well, good morning, Shona. Happy to be with you. These are indications of a continued healthy and robust consumer spending. It really caps off a very strong third quarter result, and particularly what we look at. This is the start, kind of the momentum heading into the fourth quarter. It's a handoff from Q3 to Q4, and it shows that the consumer continues to power along here, and that's positive, right, for the overall economy. It's really been consumer spending buoying the overall GDP growth in the U.S. So that idea that we don't have a landing or much of a slowdown, I think that does, the data are supporting that thesis at this point.
And so with that in mind, I mean, what then do you think the Fed is going to do at this point, really kind of digesting so much of the data points that are suggesting, hey, this could be effectively what we're looking at in the soft landing scenario, or even a no landing that continues to see their dual mandate at least be satisfied more broadly? And what policy action do you think needs to be initiated, if any?
Yeah, great question. And it is really what, the markets are struggling with right now. And I guess it's a good problem for the Fed to struggle with, right? That economic growth continues to surprise in the month of September on the high side. So it was, retail sales, but before that it was employment. But along with that, inflation came in a bit firmer as well. So it does, I think, give them a little bit of, a pause. It's just to say, do we need to pause, the continued rate cuts? We kicked things off with 50 basis points. Do we need to continue that? Do we pause in November, take a little break and assess the data? I think there's still a strong argument for them to cut rates in November. They could just pare the size back from 50 to 25 basis points. But it's not a slam dunk that they will cut rates. One of the things that we're looking at is that monetary policy we still see overall is quite restrictive. The housing market is still struggling and suffering under the weight of high interest rates. Mortgage rates actually are going further north and rising because we're seeing 10-year yields break above 4% and rising. So that little reprieve we saw in lower mortgage rates, that's been erased. And you still see borrowing rates for autos and for credit cards are still very high. And remember that disproportionately weighs on lower income and middle income households. So there's still a restrictiveness, but the Fed does have to kind of debate whether they keep going and maybe that you reignite inflation to some degree, or at least you stop the disinflationary process. We don't think that's the case, but that's what they're going to be debating.
Why are you so confident that we're still in this downward trend when it comes to inflation?
Really, when we look at the bottom-up factors, we don't see a lot of reason, to worry about some of the pop in the readings that we got in September. Like there were idiosyncratic increases, like apparel prices were up over 1%. That's not likely to continue to repeat. Even things like a little smaller in detail, but sporting events costs were up almost 11%. And then there was just other categories like that, medical care services pop. It doesn't mean that we can't have some, maybe a slower downward trajectory. But what's really encouraging is that shelter costs, the increase there slowed, and all of the data we've been looking at, new rental data, total rental data suggests that rental inflation's easing, and that means shelter inflation is going to ease, and that's a large share of core CPI, over 30%, and a large share of services, which have been the stickiest part of inflation.
Kathy Bosch-Jancic, who is the nationwide chief economist and senior vice president. Thanks so much for taking the time here with us, Kathy.
My pleasure.
Certainly. Robinhood is rolling out new tools for active traders, offering futures and index options as it looks to transform wealth management. Our own Brian Sazi is talking to Robinhood CEO Vlad Tenev. Sazi, take it away.
All right, thanks so much, Brad. Vlad, always nice to get some time with you. I know a big night for you and the team over at your first annual Hood Summit, so good to see you here. Is the reality that your customer that joined you a couple years ago, they're getting older and they just needed some more ways to invest the money that they have made on the platform, and that's why you're coming out with things like index options and futures?
Hey, Brian. Good to see you again. Yeah, I mean, we historically have been great at getting new investors into the markets, but in 2022, we shifted our focus a little bit. A lot of our new investors had grown with us. They'd become active traders. They'd become much more sophisticated. And so we've been working hard at adding all the tools and capabilities that they need to trade and invest in this market. Really, Hood Summit was all about that. It was the biggest event we've ever held for our active traders. We announced index options, futures, as well as a new desktop platform built exclusively for active traders called Robinhood Legend. And I think, so far, the products have been very well received. We've had over 800 of our active traders with us in person here. 1.7 million looked at the live stream on X. And feedback we've gotten is that these tools are powerful and they're well designed. And I think customers are really going to like them.
How is that, I guess, transition to having even more sophisticated active traders on the platform? How does that change the financial profile of Robinhood?
Well, so the majority of our customers right now, and consequently our trading activity, is on mobile, where we've been a leader. But if you look at the broader market, about half of trading happens on desktop and web, because the additional screen real estate allows traders to do different things. Like if they wanted to trade from the chart, or at least trade with the market data and the tools available on one interface, it's just more difficult to do that on mobile. So if you're looking for a little bit more advanced tooling, desktop is still important. And we weren't really competing or offering products in that space until now. So I think the potential could be quite big to expand Robinhood's footprint among traders.
And how big is the opportunity for, I guess, investors not familiar with your transition? You and I have talked a lot in the past about the transition to more wealth management service. How big an opportunity is just being involved with futures and index options look like for Robinhood?
Yeah, so Robinhood's focused on three things. The main thing is actually becoming the market leader in trading. And we've been growing market share over the past few years. I think last time I was on your show, I mentioned that throughout 2023, we grew our options market share something like 19%, equities by 14%. And we believe that we're on pace, and we eventually believe we can get to the market leader in this category. Certainly we're there on mobile, but of course we have to expand beyond that into more tools and more platforms. So that's a part of it. But also we see an opportunity with the big wealth transfer that's coming in the next few decades. A lot of trillions of assets and wealth are shifting from silent generation and baby boomers down to younger generations. Robinhood has such a position in the US with the younger generations. Our app is very commonly used, close to ubiquitous. And so we're rolling out all kinds of tools. I mean, Hood Summit's really about active traders, but we believe the long-term vision is for all of your finances, for you to trade, to invest, to earn through Robinhood. And we believe we can serve every type of customer around the world with amazing products.
Vlad, I'd love to get your thoughts on this one. So, the old school money management firms over the past decade, they've gone out there and acquired all these innovators. And I think you talked a little bit about this during your presentation. So what does it mean now that these trading platforms are owned by the old school establishment? Who innovates? I mean, of course, you're going to say, Robinhood is innovating, but like, what does it mean to the active trader or the person trading stocks if you don't have a group of companies not owned by big banks out there innovating and trying to change the game?
Yeah, I mean, I think that's been a big problem for today's active trader. All of the small independent platforms that cater to them have been gobbled up by large incumbents, and the incumbents basically view these customers as leads to high-cost wealth management services. Like they don't really care too much about the trading aspect of it, and so they're doing forced migrations of these customers. They're migrating them over to their own systems, which they haven't really been liking. I mean, we've been seeing a lot of complaints around the TD Ameritrade to Schwab migration in particular, also E-Trade to Morgan Stanley. And the platforms are being put on the back burner. There's less of an incentive for these large wirehouses to invest in active trading platforms because so much more of the revenue and the focus is coming from wealth management services. And I think that's a problem for customers, also an opportunity for Robinhood. And I think coming out with a modern desktop platform that is built with the latest technology right at this time, I think hopefully customers will see that serves their needs and fills the gap left by this huge wave of consolidation and kind of the removal of the smaller independent players from the market.
Vlad, lastly, the economy is proving very, very resilient. We had that 50 basis point rate cut, but the economy continues to surprise on the upside, and it is realistic that maybe the Fed is not out there cutting rates on a prolonged stretch as many in the market thought about just a couple weeks ago. Does the street have it right in terms of Robinhood, in terms of their modeling? If the Fed is not out there cutting rates, that has to be good for Robinhood, and you continue to benefit from the tailwinds that you have seen over the past 18 months.
I think the street, my observation after being public 3 years, they tend to extrapolate what they've seen in the recent past. And not everyone does this, but there can be a tendency to look at where the hard numbers are and the past to predict the future. And I think what we aspire to do with Robinhood is continue to change and evolve. And the one thing that I think is a little bit has been hard to model is all the new products and kind of the torrent of innovation that we've been putting out in the market. So yesterday at the Hood Summit, we announced 3 products, index options, futures, and of course, Robinhood Legend, along with a suite of smaller improvements and nice features that customers have been asking for. So the product keeps getting better and better. We're nowhere close to done in fulfilling the mission. And I think over time, to use Benjamin Graham parlance, we want this to be a heavy company and kind of like ignore the short-term up and down fluctuations of the stock and just focus on building shareholder value over the long term.
Always great to snag some time with you, Vlad. Nice touch bringing your dad on stage last night. That was pretty cool stuff. We'll talk to you soon. Good luck.
That was a lot of fun.
Good luck on the launches.
Thank you.
All right, Shauna, back to you.
All right, Saz, thanks so much for bringing us that interview. And of course, our thanks to Vlad as well. Coming up next on Morning Brief, Expedia shares surging while Uber drops on reports that the ride-hailing company explored a potential bid for the travel company. We've got those details ahead. Plus, we'll have continued coverage on the semiconductor space from TSMC to the technicals. Got you covered there. And we count down to the opening bell on Wall Street as the market rotation continues with small caps taking the spotlight, at least for now. We'll discuss that and much more coming up on Morning Brief.
Time now for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, Uber has explored a potential takeover of Expedia. That's according to a report from the Financial Times. It would be the rideshare company's largest acquisition, with the travel booking company worth nearly $20 billion. Expedia is. Now, Uber's interest is reportedly in the very early stages here. No formal approach has been made and no discussions are currently taking place, it seems, between the two entities. However, you're taking a look at shares reacting to news of this, and there's also an analyst note out. We'll get to that analyst note in a hot second here, but I kind of came up with 3 key reasons why people should actually care about this, because even in our morning meeting, I was trying to figure out, all right, why do we care? They haven't talked yet. We haven't received what the premium would look like at all, but here's why you should care. Number one, Expedia owns Verbo. That should be, a hatred sign for Airbnb or Airbnb stock. That should hate to see an Expedia Uber deal potentially coming. But the reaction there right now for Airbnb muted as of now. That's light fare right now. Winter release from Airbnb, that was yesterday. So we'll see how much that's still playing into the stock. However, here's one big reason why this is potentially good for booking. Elevated forecasting clarity here. You think about the advanced integration into Uber bookings. If they're able to create this super app that would be tied into travel itineraries, airport pickup and drop-offs, plus that data insight into the demand pockets regionally as well. That would be massive for what Uber is able to really foretell to some of the investors on a quarterly basis. And then you add in the depth of data that would certainly be brought to the fray here. Consumers served would catapult some of the active membership as well. So I would say this is a major win for Uber if they were able to pull this off.
Yeah, and also just the connection between Dara, the CEO of Uber, and his past experience as the CEO of Expedia. He led Expedia for over a decade there, so obviously there is some synergy. And what was called out within this analyst note from Milius this morning was talking about the fact that this would really, if this was true and there were to be further talks or further expansion plans down the line, this would really show Uber's push to become a super app here and really taking it to the next level, one-stop shop for all things travel. And I think that almost tells us more about the direction here from Uber. And then just taking a step back and talking about maybe more the macro landscape. You and I have been talking about the return of deal-making activity. We're clearly seeing that within the bank earnings over the last week or so. And so when you see the potential size of this deal and what this would ultimately mean for Uber's larger footprint here going forward, you also have to think that maybe we could see more of these types of deals and more of these sizes of deals here going forward into the new year.
Yeah, absolutely. Expedia carrying about just shy of a $20 billion market cap at this juncture.
All right, guys, let's move on to regional banks. Regional bank earnings out this morning, a slew of them here. So let's break it all down. M&T Bank beating third quarter profit expectations on fee income strength. And you've got Truist Financial reporting higher profit and revenue boosted by investment banking. Huntington Bank shares and net income seeing a decline, but the company does expect loan growth to continue. And finally, KeyCorp's profit rising on higher fees and interest income, but revenue falling short of the street's expectations. You can see M&T, the only bank moving to the upside here in extended hours in the pre-market trading, up just about 2%. The following 3 moving to the downside. So let's focus on M&T and maybe why the street is a bit more optimistic by what they saw from there. So again, the quarterly performance prelim, fourth quarter expectations driving net interest income to the high end of the previous full year guide. We've seen this beat and raise or beat and at least encouraging commentary sometimes being enough here for the street. And you also talk about the fact that we've seen the Fed start to cut rates. I think this is ultimately the massive question here for so many of these banks, what this means for some of their loan growth, for some of their projections going out into 2025. And obviously regionals could have a bigger impact there just in terms of what this could mean for growth down the line.
Yeah, one theme that I'm kind of drawing a through line for all of the bank earnings that we've seen over the course of this earnings season thus far is on the fee structure. Huntington was talking about this, and good for investors, good for the company itself and the financial performance, something that the customers are clearly seeing some value add on. And the CEO of Huntington was talking about that, being very pleased with a very strong performance in their value added fees business. That is something that we've heard from the larger banks. Wells Fargo most immediately comes to mind on that front. Also, let's talk a little travelers here this morning, reporting a big jump in third quarter profit boosted by underwriting strength and investment income gains. That offset the insurer's catastrophe losses, which were up more than 10% due to Hurricane Helene and severe wind and hailstorms across several other states. You can only wonder, especially for the current quarter impacts, how that's going to continue to, especially with the hurricane season not fully being accounted for in the quarter that they're reporting for, how that's going to continue to transpire into this current quarter and what that'll mean for some of the forecasting as well here for travelers.
Yeah, and I think that is a big question mark going forward, but it looks like, at least for now, the street looking past whatever that cost could be. And remember that there has been a number of estimates out there. Moody's modeling this out, saying that the two storms combined are expected to cost the industry as a whole as much as $55 billion. So again, when you take that into account and break it down here, it could be a headwind for travelers in the current quarter. But again, looking ahead and looking at some of the profit gains that we've seen, the fact that it did soar by so much, the fact that we did see this massive boost in the underwriting strength, that is enough here for the stock, at least for now, continuing. We just had a longer term chart on the screen there, but continuing that movement to the upside.
Yeah, just one figure here for investors to remember over time here. In 2024, there have already been 20 confirmed billion-dollar disasters by NOAA. The average for the past 43 years is 8.5. And so as we continue to see that climb, companies like travelers, especially for investors out there, you continue to look at what those claims and the catastrophe losses look like.
All right, coming up, keep it right here. We've got the opening bell on Wall Street. We'll be right back. And that's opening bell on Wall Street. Let's do a check of the markets as we kick off today's trading day. You can see the confetti at the Nasdaq. We're actually looking at gains here on the heels of the stronger than expected retail sales print and also the better than expected jobless claims data out this morning. So we'll see whether or not that is enough for this bid that we're seeing, at least at the open, to carry through into today's trading day. You've got the Dow just above the flat line, up just about 0.1%. You can see the S&P pushing further above and getting closer and closer back, a bit just shy of that 5,900 level. You're seeing it up just about 0.5% here at the open. Nasdaq is also moving to the upside here as it calibrates. Russell 2000, the small cap trade, has certainly been catching a bid here of the most recent trading days. That's moving to the upside here once again today. And taking a look at the Treasury market, 10-year yield moving to the upside. Still just high at that 4.1 level, but again, something to watch here throughout today's trading session. Taking a look at the sector action, what we're seeing play out, at least here at the start as things continue to calibrate. You have the financials sector among the leaders here this morning, up just about 0.5%. Technology catching a bit of a bid on the back of the TSMC, better than expected results here. That's helping the chip stocks rebound from the earlier sell-off that we saw on the heels of some worrisome signs out from ASML. Again, communication services also moving to the upside. On the flip side, we've got healthcare as an underperformer today. And since we are seeing tech by far the leader within this space here today, let's take a look within the Nasdaq 100. You're seeing a lot of those larger cap tech names moving to the upside, leading the way. Nvidia shares up just about 3%. They're talking about that rebound from the earlier sell-off that we saw earlier this week. And more specifically, just taking a look at the chip sector here, you can certainly see green across your screen. So we're seeing a rally here, helping to reignite or helping to really, I guess, put some optimism back in the market following those fears that we saw earlier this week. You've been at Broadcom, Brad, up just about 3% here this morning.
All right, thanks so much, Shauna. Let's turn now to today's strategy session. The market rotation is in full swing with the small cap heavy Russell 2000 hitting its highest level in 3 years as investors shift away from mega cap tech here. Joining us to break it all down is Michelle Snyder, MarketGauge.com chief strategist, and perhaps not an outright shift away. Great to see you, by the way, Michelle. Not an outright shift away from mega cap tech, but it certainly is a broadening out that we are seeing into some of those small caps. So on the technical level, can you break that down for us? What type of profit taking we might be seeing in tech that's leading into some of those inflows in small caps?
Well, a lot of it is going to be based, of course, on the interest rates. And so I think a lot of the market that's broadening, particularly if you're looking at small caps, it is very much hopeful that the rates at least have peaked and will actually go down. The 50% of the 50 basis points rate cut that we had recently, yields have gone up since then. So while we're at all-time highs or close to it, not quite there yet, we have to really be wary here of what happens with the rates going forward. The street is very heavily short in terms of the rates, and they're anticipating higher for longer, which could mean that this could be sort of a false breakout, but we don't know. This is the nature of October. It's very volatile. However, I don't want to sound pessimistic because on the optimistic side, so many things are tied together. So you're mentioning the Russells, but clearly regional banks are tied to that. We have healthcare, which is weaker today. So that's one of the reasons why IWM is slightly red at the open. But financials are a big part of that in terms of the small caps. And then, of course, you have to look out at the retail sector, which we had great sales today, retail sales. And that, too, is flirting with all-time highs. So we may need a little bit more patience, Brad, here to really see if this is a sustainable broadening. Certainly, it is a bullish season. After 2 years of a bull market, by the third year, generally it goes up. So we're optimistic, but we are not flying into everything yet.
Michelle, what will give you that confidence?
You know, I think, Shauna, the big thing for me and our clients right now that I have my eyes on is really going to be the consumer. Everything is really ultimately up to that. Yes, of course, we saw great bank earnings, and now with regional banks today, MT&T being a strong mover. But it's going to be what happens here as we get into closer holiday shopping, whether or not people are going to feel better about inflation, even though the numbers are suggesting they're down. Inflation is still being felt in a lot of different places. So if we see XRT, I love to use that one, which has been in a 10-month consolidation, which is mind-blowing, actually, if you're a technical trader. If we can get through this 79.80 level and sustain it, I think that I would have to say, put your blinders on to any bad news and just jump in.
And so with that in mind, where are the kind of dip buying opportunities that are most ripe for the taking?
Well, if we're going to stick to the retail space, Brad, I have been very keen all year on what's trending for 2025 and already starting, which of course is the vanity trade, which is basically the trickle effect of the diet drugs and the new consumer, if you will, that will enter the market in a way that they haven't been before because they feel better about themselves. So names like Ulta are still very cheap. Elf had a huge crash. That still looks very cheap. Some of even the drug companies related to that, like Novo Nordisk, these things also look cheap. In terms of the tech, I mean, we cannot deny that that's a growing field. Obviously, TSM blew the street away today. So I'm watching some of the ones that may not necessarily be catching up as well as they should, like ASML, if it can get back over 700 this week, could be interesting. Otherwise, the ones that are very rich are volatile. So that's one big area that I'm looking at in terms of the retail space and also in the tech space.
Michelle, you briefly mentioned ASML, and I want to specifically talk about Nvidia because that was caught up in the selling pressure that we saw earlier this week. What are some of those key technical levels that you're watching, and is there reason to be maybe a bit concerned that we could see a broader pullback, and then obviously the ramifications?
Well, yes. I mean, what we're seeing so far in the last couple of months is incredible volatility in that space. And generally, that happens before some kind of a sea change. Now, when I say sea change, I don't necessarily mean that I would be negative, but it could mean that we might see Nvidia fluctuate between, let's say, 115 and 150. Right now, it's trading close to the all-time highs, which I think is 140.79. So that's a good sign, but I wouldn't necessarily be piling in here. Actually, you just showed it up, so it's come off a little bit since the highs of the morning, 138. To me, that means that if you're in it and you're a long-term passive investor, fantastic. You know, you're going to sit out any type of gyration. But if you're a newer investor or somebody who, like Druckenmiller, got out and is looking to return into Nvidia, then I think it would behoove you to be patient. And also, like I said, really, I think the opportunity might be if this broadening in the market is sustainable.
So should people be fearing the double top at this juncture in Nvidia?
Well, it's hard to say it's a double top yet. I mean, right now we've just slipped off a little bit. But what I think it does suggest is that there are sellers up there, people taking profits. And that means to me that you might want to buy a new high in that, but you have to wonder what your risk is. So if it is a double top, I think the good news is if you're patient and you wait it out and you can get an opportunity to buy it another $20, $30 cheaper, then that would be amazing. And that's the long-term growth of Nvidia, of course.
All right, Michelle Schneider, always great to have you at MarketGauge.com. Thanks so much for taking the time to join us here this morning.
Thank you so much.
It's time now for our chart of the day. Let's send it over to Catalyst co-host Madison Mills for a look at volatility in treasuries, Maddie.
Thanks so much, Shauna. So let's take a look at the MOVE Index. This is a measure of the volatility that we're seeing in Treasury, specifically over a 30-day period. And what we can see here is that volatility in Treasuries continues to edge up, hitting its record highs of the year for the month of October and up 36% from its lows from the beginning of the month of October. So why is that? Well, one reason is that 30-day period. It's now including the November 5th election date, right? So we are seeing some volatility as traders are digesting any potential outcome that could come in from that election. But why am I showing you this chart in general? Why should you care about this? Well, there are two big reasons. One of them is that if you're seeing this much volatility in bonds, that's concerning, right? Bonds are our safe haven. They're our steady boyfriend, right? And now suddenly we're seeing all this volatility. Maybe that's one reason we're seeing gold, for example, hitting such record highs this year. Investors looking for that safety elsewhere, given the volatility that we are seeing in the broader bond market. The other big reason is that we've got this deficit problem that's kind of always looming in the background of our day-to-day lives here in the United States. Volatility in the Treasury market in particular can be a helpful tool in measuring when that deficit challenge is going to actually tip over to becoming a real problem instead of something that we just talk about all the time. And that's especially true as we are heading towards that November 5th election date, because both candidates we know are not necessarily fiscally conservative. Spending measures on both sides of the aisle there are a big issue moving forward for the deficit, and that's partially reflected here in the bond market. The last thing I do want to mention, of course, the Federal Reserve, a key mover of the bond market, and given that the Fed has been so data dependent, Treasuries are moving pretty rapidly off the heels of any data print that we get. We've certainly seen that this morning off the heels of that better than expected retail sales data, seeing Treasuries and yields rather moving to the upside. So as we have the Fed being so data dependent, the Treasury market is data dependent as well. And that's why we see a lot of whipsawing here, guys.
All right, with just one analogy at 9:40 a.m., Maddie, you send the minds of steady boyfriends into some deep existential fact-finding and ultimate soul-searching. We'll see. Thank you so much, Maddie. Appreciate it.
Do you fit into that category?
I'm just going to read this next thing. Taiwan Semiconductor shares surging after an upbeat and earnings beat. We break down how this might be the next catalyst for the chip sector. That's right after the break.
Taiwan semiconductor shares rallying, the chipmaker lifting its full-year outlook after beating earnings expectations in its third quarter, thanks to strong demand for its advanced AI microprocessors. The beat reigniting some enthusiasm in the chip sector after ASML's disappointing earnings report earlier this week triggered that sell-off. To discuss what's next for the sector, we want to bring in Bob O'Donnell. He's Technalysis and Research President and Chief Analyst. Bob, it's great to have you back here on Yahoo Finance. Let's talk about the state of play right now for chips, because the narrative at the start of the week on the heels of ASML's print was very much whether or not we're seeing peak demand. The results that we got out this morning, has that pretty much put those fears to rest?
I certainly think it has, Shauna. I mean, look, I think the ASML thing increasingly is going to look like this unusual blip for the semiconductor industry in general. I mean, a lot of it is tied to China-related issues because of how much of the purchases of ASML goods were from China, and that's going to go way down. Plus, you had some challenges with Intel and Samsung. But look, it's not an overall industry thing, and TSMC is much better bellwether, I think, of where things are going. So, yeah, bottom line is, I think we saw not only the huge beat and then the raise, and then the discussion even into next year. Clearly, I think the people are having a hard time accepting it, but look, this AI thing is real, the demand is real, it's continuing, and there's a lot of opportunity moving forward.
How much chip fabrication entrenchment and wafer fabrication entrenchment does TSMC still have, and for how long of a lead time do you believe, Bob?
Well, I mean, look, Brad, they have they have massive amounts of equipment. They're still buying a ton of equipment from ASML, by the way, as well as Lam and some of the other folks who build the equipment. But the bottom line is the capacity they have there is absolutely enormous, and it's going to take a long time for people like Intel to catch up. I mean, I think Intel, hopefully we'll see them continue to grow. That's going to be important for the worldwide stability of the semiconductor supply chain. Samsung obviously as well, and then you've got people like Micron and memory and everything else. But look, TSMC is just extraordinarily well positioned, and that's why there's so much focus on them, because what happens there really drives the vast majority, especially of the high-end semiconductor market that we're seeing for AI, that we're seeing for the latest smartphones, that we're seeing for automotive. So like I said, it truly is the best bellwether.
Bob, UBS calling out some growing divisions within tech that I'd love to get your thoughts on. They were focused on the strong AI demand versus the mixed trends that we're seeing on consumer electronics. Is that consistent with what you're seeing?
Yeah, I mean, because remember that a lot of the AI chips that we're seeing are being placed into, Meta data centers and Google data centers and Microsoft data centers, right? Those aren't obviously consumer products. So we're starting to see some AI-based chips integrated into the latest PCs, the Copilot Plus PCs. I happen to be here in Seattle for an event for Lenovo. They have a whole bunch of their Copilot Plus PCs, as well as HP and Dell. We've got Qualcomm doing some of their chips. Intel and AMD are offering chips to these folks. So, and then of course Apple with their chips for the iPhone. So we're seeing that, but that's a much smaller piece of the puzzle. It really is these large data center chips that are really driving the revenues moving forward, and that's why you can see a disconnect, but recognize that they're just two very different things.
Is it clear how sequential those purchases are going to need to be, though, for the chips that are going into data centers? I mean, how rapidly is there going to be a churn rate on those chips that Nvidia, that the companies as well that are producing and fabricating them can ultimately rely on and kind of bake into their recurring revenue estimates?
Well, look, obviously, if somebody had the complete answer to that, Brad, then we'd be all set. But I think the bottom line is, Nvidia has said, look, demand, there's still I can't remember how many, almost a year backlog for Blackwell, the latest Nvidia chips. Now we have AMD. Just last week, they introduced their new latest AI accelerator to compete with Nvidia. So you've got that going on. Intel has their Gaudi chips. They're a much, much smaller player in this area. But I think it's clear that there's enormous demand. And remember that we're still seeing growth of all these AI applications. Companies are building data centers as quickly as they can. And what's also interesting is right now we're in this process of AI training, where a lot of huge amounts of computing power is being used to train and create these new models. Over time, as new chips get developed for training, some of the existing chips can be leveraged for inferencing, and yet even with that reuse, the demand is still enormous. So long answer short, or short answer long. Bottom line is, I think there is going to continue to be demand for quite some time, because it's clear that the evolution of these AI models is still very early, and there's many, many more years to come in that regard.
So Bob, given all that and given that bullish demand that we are seeing on the AI front, I think many investors are trying to figure out who is going to be the first to reach that $4 trillion value. Is it going to be an Nvidia, or is it going to be a player like Apple? What do you think?
It's a tough call, Sean. I mean, look, you can make good arguments for a lot of different folks, for Microsoft, for Alphabet/Google, for Nvidia. All of those companies have a huge play, but there's so many different factors. I mean, remember that the AI piece, even as big as it is, for most of those companies, is only a smaller element, right? I mean, Apple sells a ton of other stuff that's not necessarily AI related. Same with Microsoft, same with Google/Alphabet, and even true with Nvidia. I mean, the vast majority of their revenues now are these AI accelerators. But, AMD as well, I mean, we're going to see them grow. I don't think they're going to be one of the ones to get to that level. But the point is, there is a lot of different factors going on. Trying to make the call of which one is going to be the first to hit that $4 trillion, I don't know. It's going to be tough. But I think it's clear that there is still continued strength, continued robustness in the market, and continued demand. And, one last thing I'll mention is we're also just starting to see the beginnings of individual companies starting to purchase servers with these GPUs in them. And that becomes a very interesting opportunity moving forward as well.
Yeah, on the question of who's going to hit $4 trillion in their market cap first, I imagine all those companies that you mentioned are channeling in sync, saying it's going to be me. Bob O'Donnell, Technalysis Research President and Chief Analyst, thanks so much for taking the time.
Thanks, Brad.
Coming up, everyone, trending stock stories. We're going to break down the latest from Apple, Nestle, and CSX. Oh yeah, get pumped. Stay tuned after the break. We're taking a closer look at some trending tickers this morning. Apple, Nestle, and CSX. We're doing it in 30 seconds each or less. Let's go. Apple reportedly worked with Chinese automaker BYD on its now canceled car project, according to Bloomberg. Now, the two were working to develop long-range batteries using lithium iron phosphate cells, known in your hood as LFP. Spokespeople for both Apple and BYD declined to comment to Bloomberg. BYD did send an emailed statement saying the concept for the Blade battery originated with BYD engineers who independently developed this LFP Blade battery. BYD holds complete property rights and patent rights for the Blade battery. What you do need to know, of course, is the remembrance RIP, or maybe not, for Project Titan for Apple here that ultimately cost the company about $10 billion. Investors still trying to figure out if there's any shrouds of that they can take into future projects.
Yeah, many are still trying to figure out what exactly that means ultimately for maybe that longer term play. All right, next up, let's take a look at Nestle cutting its sales and profit guidance, now expecting organic sales to rise just 2% this year versus a previous guidance of 3%. The company's new CEO, who took over in September, he cited weakened consumer demand and actions to reduce inventories as drivers for that reduced forecast. Despite all that, though, we're looking at gains. You might be asking yourself why. A lot of that has to do with the earnings call, some of the commentary from their CFO saying that analysts should not expect a steep decline in profitability in 2025. That was enough to reassure some of the skeptics on the street. In addition to all of that, the new CEO who just took the helm in September also announced the fact that he will be streamlining the executive ranks. So again, a reorganization as Nestle looks forward.
All right, and lastly here, let's take a look at transport company CSX. Citing the recent hurricanes as a factor behind the company's third quarter earnings miss, the company's CFO estimating revenue impact from Helene of $10 to $15 million at the end of the third quarter. The fourth quarter losses are expected to run around $50 million. They also pulled guidance here at the end of the day.
All right, coming up next, we've got Catalyst. We'll see you in a few minutes. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. 30 minutes into the U.S. trading day. Let's get to the three catalysts that we're watching this hour.
First up, we hone in on today's strong retail sales data and get a look at the Fed's next move with Mark Zandi. He's the chief economist over at Moody's. What are his projections for the economy amid the Fed's rate cutting cycle and after the upcoming presidential election?
Plus, we zero in on the candidates' tax and spending policies as the federal deficit swells to $1.8 trillion.
And with AI ambitions at an all-time high, big tech sparking a nuclear power revival. We'll break down the moves by Microsoft, Google, and Amazon, and whether the utility sector is the next big AI play. Signs of economic resilience in the data this morning. Retail sales posting a solid gain in September and jobless claims coming in below expectations. Our next guest previously expressed concerns that the Fed was behind the ball, telling Yahoo Finance back in August that the Fed should have cut rates months ago. So how does the latest data play into his current call? Well, we've got him here to discuss. Mark Zandi, chief economist over at Moody's Analytics. And Mark, it's great to have you on the show with us this morning. So we had the upside surprise on retail, downside on jobless claims. Is this Goldilocks or is this potentially a concern of too much growth?
Feels pretty good to me. I think the economy is growing. If you take all of this data and see what it means for GDP growth, that's kind of the top line number for the economy. It's about 3%. So real GDP growth is about 3%. That's what it grew in the past year through the second quarter, and that's what it is tracking in the third. And that's a really good economy. That feels really, really good, particularly in the context of the fact that the supply side of the economy is growing even more quickly. We're seeing a lot of labor force growth, a lot of productivity growth. So we can grow this quickly without generating inflationary pressure. So it all feels pretty good, particularly if the Fed stays on course and continues to push rates lower as they are signaling that they will do.
So, Mark, why are you so convinced that the Fed should continue to lower rates at this juncture, at the next meeting, even if some of these economic data prints are showing that maybe they shouldn't be in such a rush or don't have to be in such a rush?
Two reasons. One, they've achieved their objectives. Their mandate is to achieve full employment. Check. 4.1% unemployment rate is full employment. And the other objective, of course, is low and stable inflation. Check. They've achieved that as well. I mean, we'll get that read on the consumer expenditure deflator next week, but it's going to show that on a year-over-year basis, it's at 2% on the nose. That's their target. So no reason to keep rates high, well above what's equilibrium, that rate that's consistent with policy either supporting or restraining growth, because you run the risk of breaking something in the economy or the financial system. And the other reason is the reason I just gave. The economy's potential rate of growth is a lot higher. We're growing 3%, but the economy's potential is closer to 4%, and that's why unemployment has been ticking higher. Now, if that's not a big unemployment rise. If unemployment were rising because there were layoffs, that would be a real problem. But even if unemployment's rising because we got more labor supply, that's an issue as well. Unemployment's rising, and we don't need to do that. So they should normalize interest rates.
So what do you think is the biggest risk right now to our economy?
That we screw it up. That we mess up things. The election is dead ahead, and that poses a bunch of risks. I mean, the first most obvious is going to be a very close, contentious election. There's no upside to that. It could take a while, days, weeks, maybe even a month or two to figure out who's president, and that will complicate things. Second, on the other side of the election, depending on the makeup of government, who's president, what the Congress looks like, we've got different risks. I mean, if it's Harris with a divided government, we've got a debt limit battle that's brewing next year. If it's President Trump with a Republican sweep, which seems like the more like a likely scenario, that's a game-changing event. We're going to be doing tariffs and deportation, and it's just a whole different ballgame. So lots of risks posed by this election.
Mark, let's talk about that potentially game-changing event. I want to bring up some of the commentary that we got from Treasury Secretary Janet Yellen yesterday. She was speaking to the Council on Foreign Relations, calling the widespread use of tariffs misguided. She went on to say that this coming after former President Donald Trump has said that he would implement at least 10% tariffs on all U.S. imports if elected in November. Of course, then the question is ultimately what the tariffs are going to look like specifically on China. That could be up to 60% in some of the commentary that he has floated. What does that ultimately do for economic growth? How big of a risk is this for inflation?
It's not good. It means higher inflation just by definition. I mean, it's a tax on goods. and it means through higher prices on those goods as imported goods. So it's higher inflation. Of course, the Federal Reserve, that will challenge their mandate of low and stable inflation. They may not raise rates right away, but they certainly will stop cutting them just to kind of get a sense of where things are going. So it's a combination of higher inflation, higher interest rates, and all that means is slower growth or no growth. So it's a diminished economy. I mean, tariffs are a bad idea. It's just perplexing. We've settled this many, many decades ago, and here we are debating it again. But, I think it'd be a very serious error to go down that path.
And Mark, this week we heard from former President Trump reiterating things we've heard from him previously about policies that could decrease the independence of the Fed. When I think about your position over at Moody's, I think about the future of the U.S. economy and ratings on the validity of the U.S. economy moving forward. How important is Fed independence to the health of the broader U.S. economy?
It's critical. It's a cornerstone of a well-functioning market economy like ours. I mean, we need a Federal Reserve that is independent, that makes decisions that aren't influenced by politics, aren't influenced by anything other than achieving those mandates, full employment and low and stable inflation. And we've got a lot of history here as well. When central banks are captured, by the executive branch, by the president or prime minister, it never works out well. Never has worked out well. It always results in too easy monetary policy and higher inflation. Not next quarter, maybe not even next year, but down the road for sure. That's going to be a problem. So I really don't want to go down that path either.
Mark, let's talk a little bit more about the policies and what could add to the national deficit and the implications of that. Because when you take a look, even comparing both candidates here, the federal deficit or the national deficit is expected to expand by trillions of dollars over the next several years. Trump right now estimated to add just a little bit more. How worrisome is that for the overall health of the economy?
That's another key risk, and another way we could screw it up. In both candidates, you're right. Both candidates are if you look at their policies, will add to the deficit. Obviously, Trump's policies will add a lot more to deficits and debt than Harris' policies will, but they both add. And, I don't know that this is, again, a problem for next quarter or next year, but it's a problem. I mean, all the trend lines here are pretty dark. I mean, particularly in the context of all the interest we're now paying on the debt. The interest payments are approaching, last I looked, $1 trillion a year. That's more than we spend on defense. I don't think that makes sense to anybody. And that's now, I mean, if you do the forecast and don't change policy, deficit debt will continue to mount and interest payments will continue to increase and our problems will continue to intensify. So, Shauna, I actually think that if we don't start to address this issue at some point, bond investors, maybe in the middle of a debt limit battle, which is, perhaps in the cards for next year, they're going to say, this just isn't working for me. You got to pay me a lot higher interest rate. And, we see some kind of event or, even a crisis. And in fact, maybe that's what we need. At the end of the day, making the hard choices here of raising taxes and restraining spending, just can't do that unless there's some real pressure here, and maybe it requires those bond market vigilantes to come back like they did in the 1990s to get us to move in the right direction.
Yeah, Mark, we've been talking to a lot of our guests just about ultimately what it's going to take for either side to address this issue. Just real quick, when it comes to the extension of the tax cuts, how much of that is critical just in terms of, or I guess how big of a factor do you see that being in making the deficit worse?
Well, according to Congressional Budget Office, it adds, several $1 trillion to the cumulative budget deficit over the next 10 years if we extend them out. So, it adds meaningfully to it. I don't think there's any possibility, though, that we're going to allow the tax rates to go back to where they were. Certainly not for those folks that make less than $400K, and probably not for the folks that make over $400K, well, at least not anytime soon. So, just another thing that's going to add to our deficit and debt going forward.
Mark Zandi, always great to talk to you. Thanks so much for taking the time to join us here this morning. Look forward to continuing our conversation sometime soon. Thanks so much, Mark. Coming up, utilities have steadily outperformed the broader market this year, and our next guest saying that the sector still has some room to run. Stay tuned. We'll tell you why. That's coming up next on Catalysts. Now time for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, shares of Lucid under pressure after the EV maker warned that it expects to report a wider than estimated loss for its third quarter. The company also planning to issue more than 200 million of additional shares, and you're seeing that the move here to the downside in the market to no surprise. You're looking at losses of just about 15%. Yahoo Finance's Pras Subramanian joining us now with the latest on that. Pras.
Yeah, hey, Sean. Yeah, the big news here, offering up to 262 million shares, likely raising around $1.67 billion. So obviously we're seeing that the stock getting hit today with that dilution, but the company's having to sort of shore up its balance sheet, waiting for the Gravity SUV to come out, hitting showrooms later this year. With only the Lucid Air sedan on sale, demand has been what it needs to be. The company also releasing those preliminary results, as you mentioned, loss from operations in the range of 765 million to 790 million, and revenue expected around 200 million, which is actually better than what Bloomberg had expecting. But back to that prior, that share offering, Lucid said it has, before the share offering, Lucid said it has 1.9 billion in cash equivalents, with total liquidity of around $4 billion.
All right, Pras, we've also got some news from Ferrari this morning unveiling its first new supercar. What can you tell us about that?
Yeah, on the flip side, you have Ferrari here, one of the top picks in the auto space, believe it or not. Their first hypercar coming here in 11 years, using, of course, a ton of race car technology, F1 Le Mans technology, but it's a hybrid. 3 electric motors and a turbo V6 producing nearly 1,200 horsepower, a top speed of 220 miles per hour. But of course, the price tag can be yours for $3.9 million. This comes after McLaren debuted its W1 hypercar only a few weeks back. So we're seeing the hypercar war scaling up here with hybrid electric technology.
All right, Pras, thank you so much. Appreciate it. Returning now to the happiest place on earth, Disney is going to let visitors skip the lines at its theme parks, of course, for a price. Here with more, we've got Yahoo Finance senior reporter Alexandra Canal. So, Allie, I feel like I've been doing this since I was a kid at Disney. I feel like there's been some way to skip the lines, but this is a monetized version of that.
Really? Because I feel the exact opposite. And you know the pain. If you've ever been to a Disney theme park, waiting hours and hours to see and ride your best rides that you want. And this is a perk that will impact the busiest rides at the parks for $400 per guest without a reservation. Now you can only ride it one time. So this is not unlimited, and only a certain number of passes will be distributed according to the company. Once we get into the new year though, the passes, they're going to fluctuate between $300 to $400 depending on the date and the demand. But this has been a complaint from a lot of attendees that lines are too long, ticket prices too high, all of this leading to a demand slowdown that we saw in the latest quarterly results from the company. Unfortunately, we're not going to be seeing much relief on the pricing side of things since California's Disneyland just implemented price hikes on certain tickets and passes. Ticket prices there, excluding its lowest price option, increasing an average of 6%. For now, Florida's Walt Disney World has not been impacted. But like I said, we have seen recent weakness at the parks, the company pointing to a moderation of consumer demand. Disney CFO Hugh Johnston previously told Yahoo Finance that he wouldn't call consumer behavior at the parks recessionary, but that, quote, they're watching their pennies a little bit more. And I've heard from Wall Street analysts really debate whether or not this slowdown is a temporary blip as consumers deal with high inflation, or whether this is a sign of a larger trend amid these price hikes. Of course, Disney is investing very heavily into the business, $60 billion over the next 10 years, new lands, new parks, new cruise ship lines. The big question mark, though, is whether they pushed it a bit too far when it comes to the pricing.
I also have to mention that you're a resident Floridian. You grew up in Florida, so maybe you know something that we all don't know.
That's true. Well, they've had fast passes forever.
They have had fast passes,
you know.
Yeah, I guess.
But you always had to make the reservation, so now you can just show up.
I'll give you the off the record.
All right, we want to switch gears here. Stick with the media space more broadly when it comes to some of Disney's businesses here, Allie, and talk about a journal report that was out yesterday, and they were talking about Peacock making some adjustments, specifically what they plan to do with the regional sports channels. What is the news there? What is that?
Yeah, Yeah,
mean?
so according to the Journal, NBC is exploring adding local regional sports networks to its streaming service Peacock. The games would still be available on television as well, important to note, but these networks would include NBC Sports Bay Area, NBC Sports California, NBC Sports Boston, and the Philly region. So think games from the Celtics, Golden State Warriors, and my hometown favorite, the Philadelphia Phillies. There have been discussions of adding these RSNs to the platform for an extra fee, according to the Journal. So yet another way to boost profits for the streaming business. And it does come at a time when we're seeing a lot of disruption at that regional level. Diamond Sports Group, which owns Bally Sports Network, that's currently undergoing bankruptcy proceedings. We've seen leagues like the NBA, the MLB, weighing on consolidation of their rights to sell to a major streaming player, like at Amazon Prime, for example. But Peacock is in a pretty unique position, right? They saw great success with the Olympics. They've been embracing sports, the opportunity that sports brings to streaming and beyond, which many other companies recognize as well. Remember, NBC was one of the 3 companies, along with Disney's ESPN and Amazon's Prime Video, to clinch that 11-year deal with the NBA. But we'll see what ultimately comes to fruition here. Comcast, they're going to report earnings later this month. I know it's going to be a big question from analysts if it's not addressed before then. In sports, it's really this last frontier of streaming, and now is a time that we're seeing all these plays being made, no pun intended. So.
Yes, certainly, and they're spending big bucks to do that. All right, Allie, thanks so much.
Thank you.
Wall Street's obsession with AI in 2024 has spurred a huge demand in power, lifting the utility sector to outperform the broader market index. Names like Constellation and Vistra have helped fuel some of those gains. The latter stock has even outperformed AI darling Nvidia so far this year. Next guest, seeing some room to run within the sector, we want to bring in Durgesh Chopra. He is Evercore ISI's managing director covering power and utilities. Durgesh, it's great to have you here. So walk us through this call that you had out earlier this week. You still see utility sector. You upgraded this sector, seeing some of those gains broadening. Where is that growth going to come from, and what does it look like?
Yeah, thanks for having me. Look, so when you look up at the index, which is the U2I, a majority of that is driven by IPPs, independent power producers, and diversified companies, which are also power producers. The regulated traditional utilities, 28 of the 30 stocks that we cover have actually lagged the market. So our call is, yes, IPPs will continue to work. Independent power producers, that is, we're pretty bullish. But broadly speaking, regulated utilities, these traditional utilities, just like you saw yesterday, will outperform the market. Now, why are we saying that? First, it's a really attractive valuation backdrop. Utilities are trading just about an average on an absolute basis, 15-year average. When I think about PE, on a forward price to earning versus the market, it's a 20% discount. But here's what's critical versus bond yields, and this hasn't happened in a while. Our house view is yields go 60 bips, 70 bips lower into the first half of 2025. If you plot that in our bond regression model, utilities for the first time in 24 months are trading at parity with bond yields. So the valuation setup is pretty attractive. You combine that with improving fundamentals. What do I mean by that? Lower inflation, lower rates, electricity demand like we've never seen before. That's a great setup for utilities, and we expect the group to outperform into the first half of 2025. IPPs still win, but utilities win more broadly.
So, Durgesh, it's interesting. I noticed that the earnings of chip companies, not necessarily in that list there. So it makes me wonder, is it nuclear specifically that is driving further gains to the upside for utilities in your view, or is it AI kind of generally? Which of those? I
think it's the latter. It's the AI kind of generally. I think nuclear is definitely part of the mix, but think about it this way. Any forecast you pick on electricity data demand, AI is projected to add 50 to 60 gigawatts in the next 5 years, right? I added up this morning all the announcements that we made on small modular reactors, plus nuclear plants coming online. That's like 4 gigs. So we're going to need more renewables, we're going to need more gas, we're going to need more utilities.
Durgesh, talk about policy implications of this. And when we think about what this could ultimately mean if there were to be a change in the White House come November, could that be bullish for the sector? How should investors then be preparing for that and the specific impact it's going to have on utilities?
Yeah, so historically, that's a great question. Historically, utilities have kind of traded bullish in this Democratic bucket because the historical growth cadence for the sector has been transition into renewable generation, i.e. reducing carbon emissions. That has changed drastically, right? Now we're talking about economic development. We're talking about top line electricity demand growth. So whether it's Donald Trump, whether it's Kamala Harris, I think the policy backdrop is going to be very supportive. Investors do think about under a Republican regime, sort of a full sweep scenario, whether the Inflation Reduction Act gets taken back. We think that's a low probability. Ultimately, I think either one of those is going to be pretty supportive because all this is needed to supercharge the economy. And I think that's a great setup. The stocks might be volatile going into election here in the next few weeks, but if they lag, we think it's a buying opportunity.
And Durgesh, let's talk about some specific names here, and Constellation comes to mind in particular, and then we'll get to some of your best ideas. I'm curious, how material is the restart of something like 3 Mile Island to future gains for a company like Constellation?
Yeah, so look, high level, the return on investment on that project is about 30%. That's massive. An average utility return on investment is around 10 to 15. So it's really massive. We think it's 10-15% value accretive. So the stock was up 10-13% following the announcement. We think that's totally fair. I'm pretty bullish on Constellation because this is just upside from plant that they're bringing online. They have 22 gigs worth of nuclear. We think there's high probability a big chunk of that gets contracted at elevated prices with these data centers. So that's the upside on Constellation, and we're really bullish. Even after the rally it's had, we think there's a tremendous amount of upside in EBITDA, cash flow, earnings numbers.
So outside of your bullish outlook for Constellation, are some of our viewers out there trying to figure out how to play this space? What are some of your best ideas then going forward?
Yeah, absolutely. Look, so I think bullish on IPPs, bullish on regulated utilities. One portion of the market is renewable companies, which has been completely left out with the interest rate yields going up over the last 2 years, right? Electricity demand is really bullish for renewable names, right? All providers and renewable names in particular, because we're going to need more wind and storage. We're going to need more solar and storage. AES is a company which trades at 8 times 26 earnings, has materially lagged the market year to date, has lagged for the last 2 years. I think that's where you go.
I know you've got a couple of other names there, but Durgesh, I am just curious for investors listening in who are seeing some of the gains here in the companies that you're referencing, and also a company like Vistra outpacing Nvidia. How can they suss out kind of whether they've missed a little bit of the optimism rally in some of these names versus some of the other great ideas that you have where there might be continued movement to the upside and a chance to get in early?
Yeah, look, I mean, IPPs, the independent power producers, specifically Constellation is one of them, Vistra is one of them, NRG that we cover. They've gone up dramatically. PSE&G is another nuclear name. The regulated utilities have been left behind. The 3 names on the list, DTE, NiSource, PPL, are regulated utilities. NiSource and PPL are top performers this year. So the way I would think about this is, look, for the regulated utilities group, when you think about valuation, the market isn't really pricing in any of this growth. They're trading at absolute valuation, which is in line with 15-year average. So that's a buy for me. For the IPPs, again, yeah, they've gone up. You look at the screen, it's like, hey, is it too late? No, because underlying EBITDA, cash flow, earnings numbers are still biased higher. So I remain pretty bullish in both categories.
All right, Durgesh, thanks so much for joining us. Appreciate it.
Thank you.
Coming up, HPE launching new products and getting ready to close on a key acquisition as the company dives even deeper into AI. We've got HPE CEO next, right here on Catalysts. And a programming note, check out Capital Gains, Yahoo Finance's look at how U.S. government policy could impact your bottom line long after presidential elections have closed. Tune in to new episodes every Friday at 12 p.m. Eastern, wherever you get your podcasts.
HP is set to close its acquisition of Juniper Networks in the coming weeks as it aims to expand its AI offerings. Here now, we want to bring in HPE CEO Antonio Neri, Yahoo Finance's executive editor Brian Sozzi. It's great to have both of you. Antonio, thanks so much for taking the time to join us here on set. It's great to have you.
Thank you for having me.
So let's talk about that timeline that was laid out. We certainly did see some excitement play out on the street when we did hear that it could be a few weeks away. Talk to us just about the confidence in that timeline and ultimately that short-term impact you see this acquisition having on HPE.
Yeah, well, first of all, we are excited about the acquisition. And we have said from the beginning that we expect the transaction to close end of this calendar year or beginning of calendar 25. So we are weeks away. Think about it, right? So the timeline's still the same. We have been having a very productive process with our regulators. And, hopefully we can close this soon so we can tell the market how this transaction will work for them, not just from the synergy perspective, but from the use of this amazing technology together with HPE's intellectual property on accelerating both hybrid cloud and AI.
I've told you this before, Antonio. I just don't think the street really is thinking about your company correctly. So once Juniper is bolted on, how does the financial profile of an HPE change?
Well, let's start with the financials. So when the transaction closes, this company is going to be a $35 billion company. Remember, we guided the street this year to be approximately $30 billion at the midpoint of that guidance. And we will add approximately $5 billion based on the Juniper latest projections that they announced themselves. And so $35 billion, but the reality is that the networking business will represent more than 15% of our company profits. So from the structural financial perspective, now our margins are going to grow pretty nicely because obviously the networking business has a different margin structure. But what excites me is what we're going to do with our portfolio. And we have been talking about an edge to cloud experience. We talk about the world being hybrid, and now obviously in the last almost 2 years with AI. And you need a very strong networking foundation to deliver on the promise of both hybrid cloud and AI. At the core, AI is a hybrid and data-intensive workload. And so by design, you have to connect this massive amount of pool of data to the right model, whether it's to training and eventually inferencing. And HPE will provide a modern, secure, and AI-driven networking fabric. And then on top of that, we deliver our solutions both with our HPE GreenLake platform in the hybrid cloud and enterprise AI, and then what I call AI at scale for model builders and service providers.
To pull a lot of this off, Antonio, you need a lot of energy, and it's not just a you thing. I mean, it's an industry thing. What do you think about some of these larger tech companies or large tech companies like a Google, like going nuclear? I mean, is that just look into the future because of what's needed to drive the systems like your company is out there performing?
Well, I think, Brian, we're going to see a spurt of innovation across multiple domains. Obviously, the energy factor here is a critical factor, not different than the networking ability to scale. And you're going to see nuclear energy and other means, renewable energy, obviously, to play a big role. Our role is actually to design systems that are way more efficient. And that's why last week in our AI Day, we announced the first industry 100% fanless direct liquid cooled system. And when you go through that architecture, actually you reduce the power consumption from air cooled to direct liquid cooled, 100% of it, by 90%. So whether you innovate on the energy front, which we need to, and as well on the system design, which we must do, then that's how the power of driving AI at scale in a sustainable way is going to play out. And then at the same time, we also need to reduce, I call it the waste on the back of that circular economy. And so be able to manage the asset life cycle, through the process is going to be very critical. And last but not least is footprint. And so when you go to direct liquid cool, we actually proved that because of the density, we can reduce space by 50%.
So how do you see that, just in terms of that trajectory, that growth trajectory? Because we saw some of the fears creep into the market this week, just in terms of whether or not we're seeing peak demand for AI. It looks like much of that has been put to rest. Where do you see that opportunity in 5 to 10 years? And you talk about this potential here. How much is that going to maybe unlock bigger AI deals for you in the future?
Well, first of all, we don't see any slowdown on the AI per se, in the sense that so far the AI has been a story around model builders and large cloud companies. But what we see now is actually a great acceleration of the enterprise. Ultimately, this is going to come down to a company like ours, right? Yahoo Finance, HPE, how are we going to use this technology to accelerate business productivity and deliver a better experience with lower cost. And so what we see now, enterprise is going from exploration to, or experimentation to actual deployment. And we showed last week a series of use cases, from molecular docking in the pharmaceutical space to customer service using bots, to financial risk assessment in the insurance business, and many, many others that enterprises are now finally getting into it, but understand that this technology is expensive, so they want to understand the return on investment and that return on the productivity. But definitely 25, 26 is going to be, in my mind, a year where the enterprise is going to accelerate those deployments.
I know you have known Nvidia CEO Jensen Huang for a while.
Yeah.
For those not familiar, do you use his chips? And what do you are customers able to get the Blackwell chip? I mean, because what I'm hearing is demand is really, really strong in the fourth quarter for that chip, which leads me to believe maybe a lot of folks just can't get these chips.
So first of all, we have a fantastic partnership with Nvidia. If you recall HP Discover, we announced the Nvidia Computing by HPE. And with Jensen, we decided to pay significant attention to the enterprise. When you think about the large-scale providers, what they want is time to market with the latest technologies. And obviously, Blackwell is a key component of that as they go from air-cooled to direct liquid cooling, more power density and more performance. And they are on track to do that. We are doing, what we call the typical work about engineering, validation, and the like. So that schedule still what it is. And I will say those customers, the large providers, will be the first to adopt. Then you have the second group of people, which we call it the tier 2, tier 3 service providers, which will be the second to adopt that because they need to have a data center that can use it. And they are more in the business to provide hosting and capacity for people who need it. And then the third piece of this is actually the sovereign, where we start seeing a significant uptick. Government or countries providing AI clouds to both the public and the private sector. And last but not least is the enterprise. But the enterprise is not about the latest technologies. It's about simplicity and easy adoption. And that's why with Jensen, we focus on that market specifically, and we co-engineer a solution that comes out of the box ready to deploy. And we have shown demos that in 3 clicks in less than 30 seconds, you can deploy an AI application. And those customers will be on the back end of Blackwell, not on the front end compared to the other customers.
Antonio, before we let you go, just to get your quick thoughts on the election, I'm curious the conversations that you've been having, some of the other business leaders within the tech space specifically, policy implications, one candidate versus the other. What is ultimately, is there one situation that's better than the other for your business specifically?
Well, first of all, we as a company encourage our employees, we have more than 61,000, to go vote and make sure their voice is heard. But as a matter of company, we focus on policies that accelerates employment, that accelerates benefits for our employees, that protect our intellectual property, and that make us competitive. So in the end, it's going to be a balance between tax for corporation, tariffs. Where is that balance? And ultimately, need to be living in an environment where it's fair to compete and win in their own merits. So it's not one versus the other one. I think sometimes we speak about one versus the other one. I think it's a middle ground between the two, to be honest with you. And I think, once the election is done, the reality will sink in. What is the most balanced approach to get the best outcome for the United States and ultimately continue to incentivize companies to invest, protect their IP, invest meaning in innovation, and making sure we continue to develop the workforce.
Do tariffs make your life tougher? Would they make your life tougher?
I think in general will make for everyone in the sense that obviously you need to have a product that's competitive out there, but also it comes on the merits of the product itself. It's not just the financial model itself. I will say higher corporate tax makes life harder because ultimately where do you invest the money, right? And we have invested a lot in intellectual property. Designing these amazing direct liquid cooled systems take a lot of investment over multiple years. And so we want to, incentivize our companies to invest more in R&D and then obviously more in talent development. I argue everyone including ourselves here at the table, will need to have an AI minor at some point, because you have to live with AI. Obviously, you do your research.
I don't want to go back to school anytime. I'm done. I'm just too old for
You
that.
have to do that.
Nobody wants to go back.
You have to do that.
No, I don't want to.
Antonio, always great to speak with you. Thanks so much, especially
Thank you.
it's great to have you in studio here this
Thank you.
morning. And of course, our thanks to Brian Sazzi as well. Keep right here on Yahoo Finance. Coming up, we're breaking down how the presidential candidates' tax plans might impact inflation and corporate earnings. That's coming up right after the break. Stick with us.
Both candidates you know, if you look at their policies, will add to the deficit. Obviously, Trump's policies will add a lot more to deficits and debt than Harris' policies will, but they both add. But it's a problem. I mean, all the trend lines here are pretty dark. I mean, particularly in the context of all the interest we're now paying on the debt.
That was Mark Zandi, Moody's chief economist, earlier this morning cautioning about the risks of the deficit. Our next guest thinks despite the growing deficit, the 2017 tax cuts could be a driver of more economic growth to come. Here to discuss, we've got Kevin Brady, former Republican U.S. representative from Texas, also spokesman for the Alliance for Competitive Taxation. It's great to have you on here with us. I want to start specifically on those tax cuts because obviously they're up for renegotiation coming up here, regardless of who is in the White House. I'm curious from your perspective, where do you think politicians will be able to find common ground here? We've heard a lot of potential proposals on both sides of the aisle about changes to these tax rates and tax cuts.
Yeah, so one, good to see you again. And yeah, I don't think either party gains by allowing $4.5 trillion of tax hikes to land on families, small businesses, on the U.S. economy. It's crucial for both parties to find common ground. There are big differences between both presidential candidates. Clearly, the tax hikes that Vice President Harris is proposing, the tax cuts, and even more from President Trump as well. And his, as you know, his reforms jump-started the economy, drove paychecks in a major way. And America leapfrogged to one of the most competitive economies on the planet. The common ground, I think, will be in the middle-class tax cuts, certainly important to both parties. I think the small business tax deduction, the new 20% tax deduction, really helped both corporations. Obviously, we did tax cuts there, but those Main Street businesses. And I think there's common ground on issues like the child tax credit as well. But they're going to have to go farther than that. We certainly have to make sure some of the expiring business provisions that drive innovation, such as research, expensing allows you to write off those big investments in equipment, technology, software, issues like that, where there has been bipartisan support in the past, I think will surface again.
Congressman, it's great to see you again. Let's talk about maybe what more needs to be done, or does more need to be done in order to offset or pay for some of these tax cuts? Because we're going through, and you can find obviously numbers on both sides of the aisle there against or supporting tax cuts. But a Harvard Law study was out finding that GDP growth from these tax cuts less than 1%. Wage increases fall short of those that were initially predicted. Given the fact of where we stand with the federal deficit, does more need to be done to offset, or I guess what more should be considered to be done to pay for some of these tax cuts?
Well, first, there is no amount of tax hikes that will ever pay for government spending that exceeds it by double digits each year, and that's exactly what's happening now. The Tax Cuts and Jobs Act in 2017, over 70% of it was paid for on the day the president signed it, because we made $4 trillion of reforms to help offset it. Since then, we've had record revenues, both from individuals. Certainly the corporate revenues this year, I think, are the highest percentage in the U.S. history. So, in fact, we're gaining more revenue at a 21% corporate rate than projected at 35%. So those tax cuts grew revenue in a big way. The short answer is I expect Congress will have to find ways to offset some or good portions of those tax cuts. Certainly deficits have increased a great deal since 2017. It is a bigger issue, I think, certainly for Republicans in Congress. And I think one of the things we know here in these closing days of the election, both candidates are writing checks on proposals that will be very hard for Congress or taxpayers to cash. And so both presidents, however this election turns out, is going to have to work with Congress to set priorities on spending, because we simply as a country can't afford everything that's being proposed.
Kevin, your work that you're doing right now that Maddie mentioned at the top there, the Alliance for Competitive Taxation, those members include Cisco, Google, Boeing, just to name a few. What is the top issue that you're hearing from those business leaders when it comes to taxes?
Yeah, so certainly it is growth, competitiveness, and innovation. The current tax, the new reforms we did, leapfrogged us in competitiveness in a big way. It incentivized innovation, because the country that wins the innovation race really wins the future in a big way. And then, of course, it's really paychecks. I think we get a lot of these questions because the corporate rate drove the 3 highest years of real wage growth for workers than we've ever recorded. And driving the corporate rate to 28% would put us at a severe disadvantage to China, to most of our competitors. But a new study by ACT shows that a good portion of that tax hike lands on workers in paychecks. In fact, on average, a $600 loss in wages if you raise the corporate rate to 28%. The battleground states like Ohio, up to $2.5 billion a year in lost wages. Pennsylvania, even more, $3 billion. So businesses are concerned about hiking the rate so high that we lose jobs, we can't compete, can't invest here in the United States, and the workers bear the brunt.
Congressman, the Harvard study does sort of refute the idea that those tax cuts do come through into the form of wages. So I'm curious then, what is a corporate tax rate that you would be comfortable with? Can you give me a number?
Yeah, so I think that we've got the exact rate today. It is right in the middle pack of our competitors. It's modernized, so we are exceeding it. And I'll tell you, the Harvard study, I think, conflicts with the government's own data that shows how fast and how high real wages grew in 2018, 2019, and 2020.
Congressman, let's talk tariffs real quick. You've been critical of them in the past. We've seen Trump double down. He's floated extremely high tariffs, 10% across the board, 60% on Chinese goods. How problematic do you see that potentially being for the economy?
So I'm not a fan of tariffs for many reasons, and I wouldn't recommend it to either presidential candidate. But I think the big question here is for President Trump, are these a done deal that will be imposed by executive order? Or, as it was in the first term, is this leverage points to draw, our competitors to the table to try to get fair trade deals, try to level the playing field for American workers trying to compete around the world? I think that's the bigger question here. And I think within their camp, they're having that debate and haven't released details yet because they're trying to figure out how best to leverage, how best to work those issues.
Both candidates have moved further away from a conservative fiscal point of view. Congressman, is Congress going to be willing to cash in the checks that these candidates are writing to the American public?
I don't think it's possible given just the sheer expense of both candidates, both on spending, on housing, on COVID-era child tax credits, on restoring the COVID-era affordable care premiums, plus the new proposals on overtime and tips and Social Security. These are huge budget items. I can't imagine them all fitting or close to that, fitting within the budget, and certainly as the debt and deficit continue to be a major problem. So yeah, there's going to have to be some hard conversations and hard decisions made by the White House and Congress in the next term.
Congressman, always great to get your insight. Thanks so much for joining us here this morning.
Good to see you. Thank you.
To having you back on Yahoo Finance soon. Coming up, some of the biggest banks on Wall Street turning more to AI for future growth. We're going to talk about it, the implications, and what it means for their profits going forward next.
The big banks are getting in on AI. JP Morgan's Jamie Dimon telling Bloomberg that the benefits of AI are huge, but warning that some workers could lose their jobs to it, saying banks, quote, have to find a better way to help the people who get hurt by it. For more on this, we've got Faisal Hussein. He's the co-founder and CEO of Synchron. It's a company that advises 9 of the 10 largest banks outside of China, specifically on AI technology. And Faisal, it's great to speak with you here. I do just want to start on banking because we're on the heels here of bank earnings. And I'm curious from your perspective to what extent you think AI could be a driver of more profits from some of the big banks that you speak with.
Sure. First of all, thank you for having me. We believe that AI can play a big role in boosting productivity and thereby also reducing cost for a lot of financial institutions and also other enterprises. But at the same time, we're still in the very early stages of this technology. It will take time to get it to a point where, as Mr. Dimon says, it massively affects jobs. So I think it will be a gradual process. It will first be used as a productivity tool. And who knows where this will end in 10, 15, 20, or 30 years from now. Like I said, it's still very, very early for this technology.
Faisal, how quickly we're very early in the technology, obviously, for it to see the full impact of it. But in terms of the return on investments, how quickly will we see that?
I think, again, it will still take time. We're still, as users, as companies, the technology is still evolving. It's evolving at a very fast pace. We're still trying to help our clients understand where it can be applied, how it can be applied. And people are going in different directions. It will take some experimentation to finally decide on where to implement it, how to implement it first. Our recommendation is don't worry about finding the killer app for your company within your enterprise. Start with simple productivity-focused initiatives where each individual in the enterprise can save 5 minutes here, 10 minutes there, 15 minutes elsewhere, and use that as a way of leveraging AI within the enterprise, rather than finding this nirvana, this killer app type of a solution, which takes time. So yes, it will eventually have a lot of impact within all types of enterprises, but it will be a journey.
Speaking more specifically about the productivity gains, Citigroup earlier this year talking about how the banking sector in particular could be heavily impacted by AI, and that's certainly what Jamie Dimon was talking about as well here. What have you seen from clients in terms of productivity gains more specifically and how that could impact their workforce?
Yeah, so there's a lot of what we call proof of concepts happening, trials that are happening where the technology is used in areas like client onboarding, or KYC checks or claims processing. These are intense back office and middle office operations that employ a lot of people, that has a lot of friction, takes a lot of time. There are various different types of documentation that flow through the system. No two documents are the same. So eventually it requires a human to look at those files. But especially with generative AI, we have a new technology that can help with all of that. And that can massively reduce the manpower required and speed as well.
Faisal, real quick, we only have about 15 seconds. Could it displace more than 50% of jobs, what Citigroup was saying?
Sorry, 50?
50, yes.
I think it will take a long time to get to that stage.
Faisal Hussein, always great to have you. Thanks so much for taking the time to join us here this morning.
Thank you.
Coming up, Wealth, dedicated to all your personal finance needs. Brad Smith is going to have you for the next hour.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and the tricks that you need to grow your money. Hey, on today's show, we'll break down one portfolio manager's investment thesis amid a 2-year bull market and discuss a sector and stock pick for you to consider. And we've also got the Biden administration forgiving another $4.5 billion in student debt from more than 60,000 borrowers. We'll dig into the details and reveal if you might be affected here. Plus, with mortgage rates expected to fall in the coming months, homebuilder confidence is edging higher. We'll talk about the state of the housing market with the National Association of Home Builders CEO, Jim Tobin. All that and much more. We got a packed hour, so let's get into it. Let's take a look first at some of the market action. 90 minutes into the trading day right now, stocks rising, buoyed by strong retail sales data. Coming off of a winning day on Wall Street with the Dow hitting a fresh record close. Investors looking to hold on to this bull market as the Fed considers its next policy move. Here to discuss the markets and his investment thesis, we've got David Wagner, who is the portfolio manager over at Aptus Capital Advisors. David, always a pleasure to grab some time and get your perspective on these markets. I mean, we teed up some fresh record highs for you to chime in on here, David. So where does the momentum continue to persist from your perspective here?
Yeah, Brad, thanks so much for having me back. You're exactly right here. I think the market's seen between 46 and 47 new all-time highs this year. But one of the coolest things that I've seen about the market, not just over the past few weeks, but basically over the past third quarter, is that we continued to see new highs from different Ys. I mean, there's no secret that the market, as measured by the S&P 500, was led by the Magnificent Seven stocks for basically the last, call it, 18 months. But during the third quarter, we really started to finally see the market broaden out. You saw some of the more relatively undervalued areas of the market start to perform well. So think US small caps, think international, think EM. And from my perspective, it's almost like investors are speaking out of both sides of their mouth, because when the Magnificent Seven was running, everyone said, hey, you know what? The market's going to start falling right when the Magnificent Seven falters. But now I'm getting a lot of questions like, hey, Dave, is this still very much a bull market now that the Mag 7 names aren't running and is kind of being buoyed by the residual remaining 493 stocks? And I'd say that's ludicrous. I mean, look at the data. We're very much in a bull market right now. And when a bull market tends to hit its second anniversary, which we just did the last week, you tend to see the average bull market lasts about 5 years. Though I would say the third year of a bull market does tend to be a little bit more volatile than normal, but it tends to be, the path of least resistance continues to remain to be higher.
And so what is your thesis amidst all of this, especially during an earnings season where the clear theme over the past several quarters has been artificial intelligence, but is there a new theme that you expect to emerge, or is it back to business as usual, focus on not just what took place in the most recent quarter, but also growth and which companies are talking about earnings growth?
Yeah, I think it's back to business as normal. I mean, like I said, this whole new breadth of the market is such an eye-opening experience for me because I am a small cap value active ETF manager. So I love seeing it on this side of things. But, I think probably to quote Animal Farm, some animals are created equal, some are created more equal. I think when you start to head into kind of the third, fourth, fifth year of some type of bull market, I think it pays to own more quality. It pays to own companies that have, operating leverage. It pays to, own companies that have pricing inelasticity, long runways of growth, and more importantly, profitability here right now. So I think those are the areas of the market that I'm really excited about looking forward.
And so with that in mind, your sector, where is the top quality sector that you're seeing kind of a basket of companies really showing that they can kind of check off the entire list of parameters that you're laying out that needs to be met in order for them to really get that quality annexation?
So I love barbelling stuff, Brad. So let me barbell this for you. And I'm going to go one consensus and one out of consensus view here. I think the consensus view here is that you have to continue to love the technological space. I mean, when it comes to me, like the thing that could really derail this market moving forward is some type of slowing in growth or some type of contraction in the operating margin of the S&P 500. And no sector shows and highlights this better than the tech sector itself. There's so much operating leverage associated with the entire sector, or even the tech proxies like in Amazon, what they have on the retail side, what you obviously have with Nvidia, what you have with Microsoft. I think you have to have that be the bellwether sector of your portfolio. But I would barbell that actually with the industrial sector, because I think there's a lot of high quality companies there that have growing top line, that have growing margins right now, that a lot of people would probably just push off to the side because, they would expect that we're heading into the latter half of some type of business cycle, and industrials are going to be more CapEx focused. They're going to be more cyclically oriented, and that they may, get hurt if the economy starts to falter at some point. But there's so much capital really flowing into just the infrastructure of America, not just on the AI side, but on the electronification of the U.S. grid side, that there's some really cool special plays out there where you could barbell, the tech sector as the bellwether cornerstone of your portfolio from a sector perspective, but then get a little style and flair with the industrial side.
David, just lastly, while we have you here, one of the huge concerns, of course, during an election year is that you typically would see a weak September and October even with a little bit of a pullback until there's more certainty that the market can really kind of hang its hat on once the election season is passed and we have a little bit more clarity about policy going forward, or at least policy inclination, or what logjam may look like. All those things considered, what are you anticipating now after we've seen the best September in 11 years, and now October continuing to show the 46th to 47th all-time highs, as you mentioned a moment ago here? What does that set up for the back and the rest of this quarter, if you will?
You're exactly right. We very much bucked the trend of the seasonality of September, a lot of the seasonality and volatility of October in election years. But I saw a pretty eye-opening statistic this morning that on average during election years from October 15th through the end of the year, the average return of the S&P 500 during those election years is almost 8%. So I would continue with the thesis that I have here, that it's very short to be the market ahead of this election, given the amount of fiscal stimulus coming into the market. Then obviously you have the Fed doing what the Fed's doing on the monetary side. But I would say that the amount of liquidity coming into the fiscal side, it's really just not going to slow down heading into the election. And whether or not a Republican gets elected or a Democrat gets elected, we're going to have about $700 billion of liquidity hit the market just on January 1st through the TGA account itself, which is going to move out of the Federal Reserve System and into the banking system, which is just going to only increase the amount of liquidity out there in the market. So all in all, it's really hard to be short this market heading into this election. But actually, you know what, Brad? Even after the election, it's hard to be short, in my opinion.
David Wagner, who is the portfolio manager at Aptus Capital Advisors. Thanks so much for the time, David. Good to see you.
Cheers.
Home builders are feeling better heading into 2025. Confidence rose to a 4-month high in October, according to a survey from the National Association of Home Builders. Let's turn to Jim Tobin, who's the National Association of Home Builders CEO. Jim, great to have you here. First and foremost, just take us into what's driving the home builder confidence right now, as we did see it edge higher.
I think the fall in interest rates, the Federal Reserve signaling that they are on a path to easing monetary policy, I think is really given our members and our survey members in particular feeling that we're on the backside of the bad news, and that we are looking forward to a lower interest rate environment, certainly for mortgage rates in the future, and that the market's going to come back strong.
With that in mind, and the market coming back strong for home builders, it's really hinging on as well the type of incentives that might be put forward for a lot of the new home buyers that are trying to figure out the best calculus around purchasing either an existing home or waiting for an existing home to come on the market, or purchasing a new home and waiting for the build out there. What is the calculus that you believe is being run, and how much do you believe that new home buyers might even be waiting for after the election to see if that $25,000 that's promised by the Harris campaign comes to fruition?
Well, I think we have seen discounts by home builders as well as rate buy downs offered by home builders to get people from a mortgage rate in the low sixes, where we're kind of hovering right now, into the fives. We really think anything with a crooked number on it really seems to be a driver for the marketplace. So those incentives, especially those rate buy downs into the 5% range, really is what we're seeing new home builders offer to get people into product. We still haven't seen the loosening in the existing market yet, but that's coming. We probably think that comes into effect really in 2025 as rates continue to fall over the course of the next year. As far as waiting for the political winds to give us some sort of certainty, I think that is very much a part of the market. I travel all over the country, talk to builders and home buyers everywhere. And there really is this kind of there's this constriction in the market because of the political environment right now. Knowing who's going to be at the top of the economy and what kind of philosophy is going to take hold as far as the next 4 years, I think has really kind of put people in a bit of a pause here, even though rates have fallen. As far as the incentives offered by the campaigns, sure, there are people that are going to wait to see if we get down payment assistance, we get some new tax credits. My advice to anybody listening to this who's waiting on the sidelines for Congress to act, don't base your plans on whether Congress acts. A lot of these proposals still have to be fleshed out by the new administration as well as work their way through Congress. So we're a long way from seeing those proposals actually become law and get into the marketplace.
You know, I wonder, given the critical position that you hold and the consistent data that NAHB is able to publish, as well as speaking to all of the different home builders out there, you know, have you been able to speak to both campaigns, and what have you heard, and what grade would you give either the Trump campaign or the Harris campaign as they're trying to figure out what the reality of the home building environment looks like post-election?
I'd give them both A's, to be completely honest with you. I think the fact that the centerpiece of their economic pitch is housing, and not just housing supply. That is a critical piece for us. I've been waiting my entire career to have the top of the political tickets talk about housing supply, and both former President Trump and Vice President Harris are doing that. And their conversations are trickling down into House and Senate races, as well as local races. So housing really is at the forefront, not only of voters' minds, but of the candidates themselves. So I give them an A. We can have a debate on the policies themselves. I like the policies that talk about adding more supply. So opening federal lands to potential development, I think is a really important piece that will add to supply. Vice President Harris's plan to offer a tax credit for builders to build to the first time or first generation market, I like that one a lot too. I don't like rent control. I think anything that suppresses prices artificially and gets federal intervention into the marketplace, that scares me. But I think overall, the fact that we've got both candidates talking about housing really earns them a lot of credibility in our builders' minds and gives us opportunity that no matter who wins the White House, housing is going to be the top of their agenda.
You know, something else that you mentioned a moment ago here was the buy downs that home builders have been aggressively paying as well. I wonder how much you anticipate that will continue to be a trend, especially knowing what it's going to take, not just to get new people into the market, but also to make sure that they can offset some of the higher costs relative to a few years back when interest rates or mortgage rates actually were way more favorable than those who were just trying to dip their toe in the water or finally trying to settle on any type of property.
Yeah, but buyer incentives really are a function of the market. And in the last 2 years, interest rates have been the reason why we've had to offer those. I think as interest rates fall and production picks up as well as demand, I think those incentives may evolve out of the marketplace. But affordability, hopefully comes back in the initial term by virtue of lower rates. And I think that's what we're going to see moving into 2025 and into 2026. Now, as production comes back, but if demand comes back quickly and the existing market is still slow to react, I think that we could see a bump up in building material costs that would offset any of those gains that we see in lower interest rates. So again, we're going to have a bumpy ride here for a little while, whether interest rates continue to fluctuate up and down. But more importantly, as demand evens out and supply starts to come back, and again, that existing market is going to be critical to the housing recovery. So we've got a long way to go, but plenty of optimism on the horizon, both politically, but I think also from an interest rate environment as well.
Jim Tobin, who is the NAHB CEO. Jim, thanks so much for taking some time with us here on Yahoo Finance. Appreciate it.
Great to be with you.
Certainly. Well, if you're a wannabe homeowner, hey, you're not alone. I'm right there in that camp with you. And you've got a list and a lot going against you. You got high prices, limited inventory, a stubbornly high mortgage rate as well right now. But there may be hope thanks to one little known factor that we were just discussing that could bring you some relief. Senior housing reporter Claire Boston joins us now to learn and discuss much more. Claire, what do we need to know?
Yes, so I was looking this week at mortgage spreads. And so spread is basically the extra yield on top of a treasury bond that goes into your overall mortgage interest rates. And right now, we have seen spreads, they're really wide. So you take a treasury bond, call it 4.1%, and you're looking at an average of about 2.25% on top of that. Historically, though, the spread is a lot lower. It's more like 1.8%. And we think that probably spreads can compress a little bit from here, just based on, kind of who is buying mortgages and really that market demand.
And so when it comes to new construction, what can you tell us about how builders are looking at condos and even townhomes?
Yeah, so one thing that we've seen in the marketplace too when we're looking at affordability is it's really hard to buy a home. And so what builders are doing is they are kind of building smaller, they are building denser. Generally speaking, the condo market is a little bit cheaper. And so for a lot of people who are really interested in buying a home, condos are the way to afford that. And builders are really responding to that demand. And, it's not gonna completely fix affordability. We still have a huge, shortage of homes in this country, but it's part of the equation.
Certainly. Now, what about single-family homes? What are we seeing there?
Yeah, so with single-family homes, same thing. Builders are trying to figure out, how do I make this more affordable in this time of higher interest rates? And so what we're seeing is builders are actually going smaller. The average square footage of a new home has dropped by about 200 square feet in the last 2 years. And that is very much just a story of supply and demand. If overall it's more expensive, then if you make the home smaller, it gets a little cheaper. It's still really tough out there, though.
Yeah. All right, Claire. Thanks so much. Appreciate the breakdown here. And everyone, coming up on the other side of the short break, the Biden administration issuing another round of student debt forgiveness. We've got the details. Before we dive into that, though, we're going to talk a little bit about saving. Yahoo Finance's Rochelle Akufo has more on saving for retirement.
No matter your age or stage in life, experts all agree that it's never too soon to plan ahead for what you need to one day retire. Putting those plans in motion when you're in your 20s, 30s, or even 40s and 50s, and sticking to them can be tough to navigate. Of course, starting sooner than later is better, but how do you know you're on track to retire the way you want?
One of the most important things that you can do when you're in your 30s and 40s is to not neglect what I would describe as the basic building blocks of a sound financial plan.
Yahoo Finance explains where to begin, starting with if you're in your 30s and 40s. Certified financial advisor and Yahoo Finance Decoding Retirement podcast host Bob Powell suggests this general rule. Aim to have 1 times your salary in retirement accounts by age 30 and up to 4 times your salary by age 45. Here's what you can do in your 30s and 40s to save for retirement and stay on track. What are your retirement assets and what are the targets? There's no one-size-fits-all to the amount to save, as that depends on a variety of factors and questions you need to answer.
What is your time horizon to retire? So is it 20 years, 30 years, 40 years? Another is, what is your tolerance for risk? How much market volatility can you tolerate? What is the amount of money that you're trying to set aside to fund your desired standard of living? That will determine how much you need to contribute, as well as what your asset allocation should be as you're saving for retirement.
Assets can include 401ks, Social Security benefits, Roth IRAs, and health savings accounts, among others. For married couples and families, it's recommended that you save enough to replace 70 to 80% of your pre-retirement income in retirement. Be sure to designate a beneficiary, as retirement assets cannot be combined. What can you do in your 30s and 40s to save more as you earn more? Incorporate your retirement assets and income into your overall budget. Focus on earning more if that's a possibility. Have an emergency fund. Maximize your tax benefits, pay off debt, and take advantage of compound interest with your savings and investments.
Create something called an investment policy statement, a blueprint for your investments. The last thing that you want to do is be ruled by emotions and market volatility and start making adjustments to your investment plan or how much you're contributing to your retirement plan based on market conditions.
To create and maintain an investment policy statement, identify your investment objective, the financial goals and timeline you want to hit via your investments. Decide on your risk tolerance, which is typically more aggressive in your 30s and 40s. Identify the types of assets allocated, typically stocks, bonds, or cash equivalents, and stick to that plan. These strategies can keep you on track and offset some of the costs that tend to hit retirement savings harder in your 30s and 40s. Housing typically tops the list, making up 32.9% of expenditures, followed by raising a family and student loan debt. Experts say it's important to be intentional about your financial priorities during these milestone years so that you're not among the 45% of Americans predicted to run out of money during retirement, according to Morningstar. And now you know how.
The latest read on the labor market indicating resilience. The number of people filing for first-time unemployment benefits unexpectedly falling last week. To break this down for us, we've got the Catalyst co-anchor, Madison Mills, back here in studio. Hey, Maddie.
Hi, Brad. So listen, it's good news-ish for the labor market right now. It fell from last week after a jump in that previous week here. So you could read that as good news for folks who are out there searching for jobs right now. But you don't want to get too excited, and that's because we are going to expect continued volatility in the labor market and specifically in jobless claims on the heels of those extreme weather events in the South. Just to run through some of today's numbers, we had a decrease of 19,000 to 241,000, continuing claims increasing to 1.87 million in the previous week. That's going to be the highest since July. You had the 4-week moving average, which is what we tend to look at to get out of some of the volatility of those weekly numbers. If you look at it every week, you'll get a little seasick. That did increase, so that is potentially a sign for concern. But again, we've got that hurricane volatility here, and it's interesting because we still have not seen a huge uptick in some of those states in the South. We did see a little bit of that last week, so it could be that some offices are continued still closed following impact of the hurricane, and also that people still don't have access to power in some parts of Florida. So that could also be one of the reasons that we're not seeing a huge uptick in that state. And that is something that we could see next week, which could be a concern for people, especially looking for work in those states.
Yeah, great points. Yahoo Finance's own Madison Mills. Maddie, thanks so much for breaking this down for us.
Thanks.
Well, the Biden administration forgiving $4.5 billion in student debt for public service workers, impacting positively over 60,000 borrowers. To discuss the impact of this latest round of student loan relief, we have James Quall, who is the U.S. Department of Education Undersecretary. Great to have you here with us, and thanks for taking the time here, Undersecretary. First and foremost here, when you think about the number of people that are saddled with student debt and have just been trying to crack into so much of that, what type of dent does this make on the overall basis, and where in efforts that have stalled are you trying to get the wheels turning again?
Yeah, you're right. There's not only 40 million people who have student loan debt, but it's a problem for their families, for their communities. And one of the impacts that student loans have is that it makes it more difficult for people to go into public service because they take out the same amount of loans, but they have to accept a lower salary. So that's why it's such an exciting day here, as President Biden has announced that we've now forgiven the loans of more than 1 million public servants who have been working in public service for 10 years and making payments on their loans.
Is this something that you believe could be replicated in the future for those who aren't currently working in public service, but actively taking on, perhaps in college or attaining a degree right now and want to work in public service, but ultimately are looking at this tranche go through and saying, well, that's not going to apply to me because I don't currently have the job right now?
Yeah, we've worked really hard to make improvements to this program permanently. So, prior to this administration, the number of public servants getting help was negligible because of all the red tape and bureaucracy. But we put in place new rules that make it simpler and fairer. We've changed how we administer the program. And we want to make sure that student debt doesn't stand in the way when young people want to become a teacher or a nurse or a first responder. We have to make it possible for people to give back.
Now, some of the debt forgiveness efforts are hung up in courts right now and just kind of hot potatoed from one court to another. Where are you continuing to make efforts to kind of, through the appellate process, move through and ultimately try to see still some sort of remediation for those who would apply or fall under those programs?
Yeah, so we're moving forward on all fronts here. In addition to public servants, we've identified another almost 4 million borrowers for relief because they have disabilities, they were cheated by a for-profit college. So we encourage everyone to come to studentaid.gov and take a look if any of these programs benefit you. The president has proposed other ideas that we believe would help borrowers that we have the authority to do. And some of those actions have been challenged by Republican elected officials. We're going to continue to fight in courts to bring relief because this really is an issue, not just for people with student loans, but for the whole country.
How likely is it that some of those efforts would make it through prior to the election in November?
Well, we're not really driven by the election timeline. We're going to keep moving as fast as we can to help as many people as we can.
And for making sure that it's possible as well, how much of this would need to go through Congress, because that is seen as another roadblock that could be potential as well?
Well, no, these are things that have already passed Congress. So we can only act when Congress gives us authority. But they have given us authority to help borrowers who are public servants, who are disabled, who are experiencing hardship. And so we want to make the most of that authority and help as many people as we can.
And just lastly, while we have you here, with regard to what this means in terms of the anticipations as to where the lifting of the debt burden might facilitate even more of the economic opportunity, where does the department really see this flowing into and other areas of the economy that this could benefit?
Yeah, some people say, it's not my problem. They chose to take out the loan. But the reality is, for these 40 million people, it's not just an economic weight for them, it's for their families. It makes it harder to buy a home, to start a business, to go into a public service job. So it's really a problem for all of us and something that we all need to help fix is the student debt crisis.
For a lot of those people, the costs might have changed quite considerably between the time that they went to college and when their kids were thinking about it, because the pitch for the same school for me, I know, was about $30,000 delta between when my parents went there as well.
That's
James
true.
Quall, who is the U.S. Department of Education Undersecretary, thanks so much. Appreciate it.
Thank you.
Certainly. Coming up, everyone, shop till you drop. I'm talking to a retail analyst about the areas where consumers are spending the most and where they're cutting back ahead of the holiday season. Stay tuned. Retail sales data topping economists' expectations during September, rising 0.4% month over month, according to the Census Bureau, showing consumers are still spending even as high prices remain sticky in some areas. Joining me now, we've got Sucharita Kodali, who is the retail analyst over at Forrester Research. Great to have you back on the program with us, Sucharita. Let's start with the sectors, perhaps, that saw the most spending: the miscellaneous stores, clothing stores, personal and personal care stores, health and personal care stores, I should say. Why are those seeing the most gains right now from your perspective?
Well, the ones that are actually the highest are some of those non-store retailers, mass merchants. It is companies that are like Amazon, Walmart, multi-category, multi-brand, value-focused retailers that tend to be doing the best. Apparel certainly has recovered from its pandemic depths. So we're seeing a little bit of, I would say, green shoots there that should carry into 2025. But the sectors that are doing the weakest are definitely home related. So anything that is related to furniture, some of the building, do-it-yourself types of retailers, those are the sectors that are seeing softness in large part because interest rates are still high.
And so with that in mind, and you mentioned and ran through some of those sectors, seeing the declines last month, electronics, gas, furniture, I mean, some of that's continuation of what we would expect or what we already have seen. What does that tell you more broadly about the consumer and how that also is something that they're monitoring within the rates as well, as you were mentioning that a moment ago, and the impact into those specific categories?
Well, the consumer certainly is still very cautious on average. So certainly there are the tale of two types of consumers. You have affluent consumers who are experiencing some of the highest stock market valuations that they have seen ever. And those are consumers that tend to continue to spend. You still are seeing things like eating out, food away from home to be relatively resilient. On the other hand, the consumer that is struggling, the consumer with loans or the consumer that is in a lower income demographic, they may be working multiple jobs, they are absolutely pulling back. And that's why you see stores like, for instance, the Dollar Channel struggling a little bit in this economy. So the consumer certainly is still cautious. And when you look overall at year-to-date spend levels, they are about in line with inflation, which means that units being purchased is not higher.
I feel like you've gotten hands on my journal, my diary, and really read through how my consumer mindset is thinking here, Sucharita. So while we're on that frame here, holiday shopping underway. I'm looking for discounts. Consumers are looking for any type of promotions that they can get. What is the outlook for promotions through year end, and where can consumers expect to get the most value for their money?
We are expecting this to be a very heavy promotional season. You have to remember, coming out of the last several years, we had everything from supply chain challenges to other issues related to the fact that retailers just were not promoting as much. So we're seeing, starting last year and certainly this year, much heavier promotional activity, especially given that consumers may be cautious to open their wallets. The way that retailers get consumers to actually purchase is by increasing the number of promotions, the number of items that are discounted, or the length of time that those promotions happen. And I expect all of that to come out in full force through the holiday season. And we also have to remember that Amazon just came out of a huge Prime Day, their big day deals just last week. And that pulled forward a lot of promotional activity. So consumers may have already purchased a lot of their holiday items. So what you have left is going to have to be driven by really high discounts and other retailers being particularly aggressive in the weeks to come.
Yeah, they do have me making lists earlier on and monitoring the behavior of some people on those lists as well. But ultimately here, Sucharita, as we think about which retailers are perhaps best positioned to benefit even throughout a promotional and a highly promotion pressured type of cycle for the larger retailers, who is best positioned from your calculus and your estimation?
Well, it's always the stalwarts. Amazon and Walmart certainly should do well again this holiday season. But even some of the specialty retailers like Dick's Sporting Goods has been doing pretty well this year. And you do have brands. I know that we hear a lot that Nike is struggling, but there are companies like Crocs that are doing really well. And those are often holiday types of purchases. They're as seasonal as anyone. So I expect a variety of different players. There are definitely going to be winners and losers. Abercrombie has had a relatively strong year. I wouldn't have expected that, but it's a bit all over the board, and you certainly have unexpected players that are exhibiting strength.
Yeah, nobody had Abercrombie as a power player on its bingo card coming into the start of 2024, but here we are, and they certainly are performing quite well here. Just lastly, while we have you, this has come up more recently because lawmakers are sounding the alarm on something called dynamic pricing, and specifically the use of it in the retail space. Kroger, Congresswoman Rashida Tlaib calling out Kroger for its use of digital price tag and facial recognition technology in its stores, saying it could lead to discrimination and price gouging. Yahoo Finance actually received a comment from Kroger's spokesperson saying, quote, Kroger does not and has never engaged in surge pricing. Any test of electronic shelf tags is designed to lower prices for more customers where it matters most. To suggest otherwise is not true. So Sucharita, all that considered, I wanted to get your take on the impact of this kind of technology in stores.
There is no question that it is not always consumer-centric, and it is something that may or may not benefit consumers. But there's a really easy thing to do. Instead of just criticizing companies like Kroger, what these lawmakers need to do is encourage kind of using technology that exists to empower shoppers. So part of any legislation to ban this type of thing, I don't think that's the right approach, but perhaps forcing these companies to do things like enabling consumers to do receipt scanning, which already exists, and empowering that information to be available open source, so that if companies claim that they're not discriminating on price, let's literally show the receipts and prove that different consumers at different periods of time purchasing the same products are not receiving varied pricing. So there is a way to use technology to the shopper's benefit, and I would like to see more lawmakers pushing for that type of a response versus just banning some of this technology outright.
Forrester Research retail analyst Sucharita Kodali. Sucharita, always appreciate your time and insights. Thanks so much.
Thanks, Brad.
Well, inflation has hit Americans hard over the last couple of years, and though we're seeing an overall moderation, there are certain areas of the economy where prices have remained a little sticky, and one of those areas, food. According to the Bureau of Labor Statistics, the Food at Home Index, aka the prices that you pay at the grocery store, jumped in September, rising 0.4% from the prior month. Now, 5 of the 6 major grocery store food group indexes increased last month. Meats, poultry, fish, and eggs. And those prices, they rose 0.8% month over month. Egg prices alone, they spiked in September, rising nearly 40% from a year ago. So safe to say, Americans are feeling inflation's pinch at the dinner table, and nearly a month out from Thanksgiving, grocery stores are taking notice, releasing Turkey Day deals to boost consumer demand. Walmart announcing today it's bringing back its inflation-free Thanksgiving meal at a lower price than last year. The meal, it features 29 items and serves 8 people for less than $7 per person. It'll come with a frozen turkey, Hawaiian rolls, pecan pie or pecan, and ingredients for a number of other Thanksgiving Day delicacies. Let's stack that up against Aldi, which released its lowest price meal in this deal in 5 years. It'll run less than $4.70 a person, feeds 10 people, and the meal includes a butterball turkey, gravy, rolls, mac and cheese, stuffing, and ingredients for more recipes. My stomach, oh yeah, it's getting hungry, and it also hurts just thinking about all the eating we're about to do here. A survey from PwC shows 59% of consumers will say inflation will probably influence their holiday spending this year. So if you're worried about the cost of food, be sure to check out the deals that could save you some cash this holiday season. Coming up, everyone, small business owners feeling confident but still struggling with macroeconomic headwinds. We'll break down the top outlooks for the rest of the year next on Wealth. majority of small business owners are feeling confident. According to a new survey, 66% feel their business is thriving. Joining me now to break down some of the results of the survey, plus even more of the sense of the state of small business, we've got Robert Rodriguez, who is the head of business banking for the Northeast region at Chase for Business. Great to have you here in studio with us.
Thanks, Brad. Appreciate it.
Absolutely. So what are you hearing from small businesses about their success right now and where they're perhaps feeling pressures as well to balance that out?
Yeah, I mean, look, you just said it, right? 66% feel the business is thriving. That's consistent with August's results. We saw 67% there. So I think we should feel really good about the consistency. I can tell you when I'm with business owners, you know, they are a resilient bunch. So they're adjusting. I think there's still some concern, right? Inflation, and you just did a great segment on Thanksgiving Day meals, right? So inflation is still a concern, 34%, you know, or have that as a watch out item. But I would say, you know, overall, despite those challenges, they still feel really good about the outlook as we head into 2025.
As they think about their outlook, how are they navigating things like employment and the labor economy as well, and thinking about their hiring plans?
Yeah, 19% of the small business owners are still concerned about labor shortages. I think it's more about retention of talent, right? Keeping those employees. At the end of the day, obviously everybody's looking for a fair wage. So, you know, between inflation and cost of goods going up, it's been really challenging for small business owners to maintain, you know, a solid workforce. But I'd say again, they're optimistic about their outlook.
And so with that in mind, I mean, it seems like right now, 37% saying their revenue is up somewhat or significantly. I mean, how do they anticipate that factoring into their own growth projections as well for small businesses?
Yeah, you know, I think with the recent rate reduction, it's really enticed clients to think about, you know, how to access capital beyond just their own wallet, right? And when we see that, it's obviously good for banks, but at the end of the day, we're seeing a more interest in clients coming to us with working capital needs. About 60% are considering a banking change right now, which is awesome. You know, so that suggests clients, you know, going out there and seeing what's out there from a banking perspective is also really interesting.
You know, it's an election year, and a lot of small businesses trying to figure out, okay, what could our tax rate look like? Or even for the products that we might be taking in from overseas, how might that impact our costs, and what extent does that mean we need to pass it through to consumers? How are they evaluating that?
Yeah, I think that's always the juggle, right? It's figuring out what's coming, you know, with it is an election year, you know, and with that, at Chase, we're here to support small businesses, whether they're start, run, grow, right? Every stage of their life cycle. I'd say for small business owners, because back to their resiliency, you know, I think they're willing to navigate the waters, but we're there to, you know, obviously be trusted advisors every step of the way, provide advice. So, you know, I think we should feel good about, you know, 60+% seeing optimistic about the turn of the year.
What policy would small business owners like to see in order to feel like, okay, they are insulated, or their business is thought about by a future administration, perhaps?
You know, I think with whatever side of the aisle you're on, I think small business owners fuel the economy. They are the lifeblood of America. I mean, you see that day in and day out.
Many of our first jobs.
That's for sure. And so I'm lucky to be in a position where I get to interface with small business owners each and every day. So I can tell you that regardless of the outcome, I think, you know, what we focus on is just being there by their side and making sure that, you know, anything that comes their way, that they're being able to adapt and prosper.
Absolutely. I still remember my first job, Stadium Grill, Westchester, Pennsylvania. Small business, local business. There you go.
I worked in a video store, Brad.
Oh, yeah?
Yeah, remember those? Like the
I do. The VHS tapes.
Yeah.
Wow. All right, Rob, we're going to talk about that during the break. Stick around. Robert Rodriguez, who's the head of business banking for the Northeast region over at Chase Business. Thanks so much.
Thank you, Brad.
Coming up, everyone, we're diving into the state of the resale market with the CEO of StockX. That's next on Wealth. Resale is extremely popular both as a side hustle to make extra cash and for consumers looking to buy something for a bit of a discount. And we want to dive into the state of both sides of that market with Scott Cutler, the CEO of StockX, coming to us live from Robinhood's Summit in Miami, Florida. Let's start with the state of the consumer. Scott, it's great to see you. Great to have you back on the program. And I know you have a trove of data at StockX that you're able to leverage and kind of read through and get a sense of where the consumer is spending or even pulling back or looking for deals. What are you seeing in your assessment?
Well, we're obviously in a challenging macro environment, but I think things are positive going forward. We've had 4 years of interest rates increasing, inflation, and now I think as consumers are looking forward, it's much more optimistic. And I certainly look at that in preparation for the holiday season, but also as we provide a platform for people to trade what they love.
With that in mind, I mean, we were looking through even recently some of the results of the Taking Stock with Teens survey that Piper Sandler puts out and really seeing some of the hot brands. And I wonder how you're seeing that kind of transpire through to your platform, brands where consumers might be pushing back and where the trends might be moving towards. And you're seeing some fluctuations, perhaps even on your site.
So the state of the resale market right now is super dynamic. This year, we've probably seen the biggest shifts in market share that we've ever seen, at least in StockX's history. And you see this also reflected in the public markets. I think on the one side, you've got the challenges associated with Nike, which has really been driven by restocks, oversupply, a lack of innovation. But if you look at the price performance in the resale markets, as well as market share gains, where is it happening? Adidas, ASICs, Deckers, which is Hoka and Uggs, and Crocs. And so you're seeing really the performance of these other brands take up the market share losses of others. It's not all bad news for Nike. I think what we see working in the resale market, particularly in sneakers, is performance basketball on the back of LeBron, KD, Book One, Sabrina, as well as in the running category. And so it's a dynamic time always in the resale marketplace. But again, these shifts have been pretty significant.
Yeah, Sabrina calling game last night. We certainly watched that and saw that in the WNBA finals. Of course, much more to come there. Much more to come as well for power sellers that we've been tracking within this industry and switching gears and really focusing on some of those resellers. For those looking to make extra money selling their collectibles or sneakers, is the cautious consumer weighing on some of their potential profits right now as those consumers are looking for anywhere where they can offset some of the pricing pressures that they're seeing elsewhere?
So StockX is a marketplace that reflects the dynamic nature of a real-time marketplace in all of the categories that we trade. And so, for example, right now, overall on the site, about 60% of the things that are trading right now are trading below retail. But that's not all bad news because a lot of the sellers, and StockX is a platform that provides that economic opportunity if you're selling. Those sellers are finding opportunities between wholesale and retail. They're certainly focused on the items that consumers have the most attraction to. And I think particularly in the lead up to the holiday, in some categories like electronics, you're going to see really active dynamic pricing, potentially way above retail prices, particularly around Sony in their mid-cycle PlayStation 5 or the 30th edition. I think that's an example of a product that will probably trade well above retail. And those are sellers or resellers that will take advantage of those opportunities that consumers are going to be in high demand for those items.
You know, that's a great point. And so when you think about, and the fact that you are more than just apparel and footwear, you mentioned you've got things like jewelry, you've got things like electronics as well on the platform. What would be your top tips for people who are looking to make sure that they can successfully be sellers of either inventory that they might have bought, haven't worn, looking to sell to someone else, and ultimately make sure that they see some success as well along the way?
In the catalog of StockX, we've got hundreds of thousands of product pages across multiple categories in sneakers, shoes, electronics, collectibles, apparel, accessories. And so I think if you're a seller, you're really looking for those opportunities for products that you really think customers will be positioned to buy. At StockX, we're really trying to unlock the opportunity also to be able to provide buyers with the opportunity to get that product very quickly. And so we launched Express Ship as an example. And here we have items, hundreds of thousands of items that have been provided to us prior to the transaction that are available for Express Ship so that buyers can get that product in just a couple of days, also from a marketplace experience. And so if you're a seller, you'll leverage that offering through StockX to be able to reach consumers quickly, particularly in the run-up for the holiday season.
All right, yeah, and that certainly is expanded as well for StockX here in some of the new partnerships with Walmart. Congratulations on that. Would love to check back in on some of the results once we've been able to accumulate a few months of that partnership here. Scott Cutler, StockX CEO. Scott, great to see you.
Thanks so much.
That's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up at 3 p.m. Eastern Time. They'll count you down to and through the market close.